sometimes you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
The Boston Symphony Orchestra presents BSO at Home, a collection of concerts, at-home lessons, and behind-the-scenes stories to enjoy while you stay at home. Learn more at bso.org/at-home.
The rapidity with which we are moving relates more to technological advances in how you can make a vaccine even before you start testing it. That makes me confident that we are going to do everything we can to determine safety.
We're in a recovery, but this recovery is about to slow down.
The longer term is not looking good right now in terms of the support for consumption.
This time we don't expect the market to go down 30-40%. We just expect it to kind of trade sideways for a bit.
The structural unemployment rate depends critically on whether you have a vaccine.
We have not solved the source of the recession. We're still trying to figure it out.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York and London for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Good morning to you all. Equity futures negative, the euro firmer, Tom Keene. An ECB decision 45 minutes away.
An ECB decision, all the reports I get, John, is this is not routine. And Madame Lagarde has a set of issues, starting with slow economic growth. John, we'll get a reset of that economic growth. Some people even talking about a lift in EU growth. I don't buy it for a minute.
It's a tricky one, Tom. You've got to have confidence in the improvement, but vigilant about the downside risk. And you don't want to boost the euro, which you know is going to hit your inflation objective. And that is the fine road she's got to travel down a little bit later, Tom.
John, what is so important here is all the conversations we've had, all the great FX analysts, they talk about a strong euro impinging at 130, 140. I've said I don't believe it. It's a lot sooner. And now here we are at a 118 level off the Bloomberg. And we're talking about this. Things have changed in a month.
Tom, we saw last week 120 gets it done. And you know the language of the central bankers. They'll come out and they'll say, we don't target inflation. We don't target FX, rather. We target inflation. But the FX channel does hit our inflation objective. It's a little bit like being a kid when your mum shouts up the stairs, Tom, and uses your full name. You know you're in trouble. And for the Euro bulls, if they hear that a little bit later from Christine Lagarde, that's the message. Thomas Keene, are you long the euro? Maybe you shouldn't be.
No, maybe we'll see that. A lot of other distractions. Of course, the market here, as you mentioned, John, futures negative 21. I know you're going to do a data check here as well. And we at Team Surveillance, we are riveted on this simulcast worldwide. John, we are riveted by Premier League opening this weekend. Abramowitz in deep study.
Oh, yeah.
Rumor is, rumor has it, Lisa Abramowitz might have chosen a team ahead of the weekend's action.
I am not going to reveal anything about this until Monday. Monday, I will come in. There may or may not be paraphernalia for my favorite team.
Crystal Palace, I love it.
The big reveal, John.
Okay. Are you going with a London club? Can you give us a sneak peek preview
of something? Please stop
I told you on Monday. You have to wait, as does everybody else. Meanwhile, there's lots going on today other than the Premier League. And as you were mentioning, that 7:45 a.m. Meeting, we're going to get that rate decision. Going to be a snoozer. The meeting 45 minutes later with Christine Lagarde speaking 8:30 a.m. Eastern will be interesting. The Euro question very much in the forefront, as both you, Tom, and John were talking about. 8:30 a.m. U.S. initial jobless claims. We're going to probably see ongoing improvement. We have continued to see that with yesterday's JOLTS reports. Question I have is, when do we reach the new normal to assess the potential longer-term damage to the labor market? And then also today, the Senate is going to vote on a slimmed-down pandemic relief bill. The Democrats may have enough to block the vote. Very interesting to see, in my opinion, what kind of give and take there will be on state and local funding. That seems to be, right now, John, the hot issue.
Well, Lisa, I've got to come in here because because you misspoke there. You said the ECB meeting was a snoozer. John and I, of course, have never said that the ECB would be a snoozer. John, I got to disagree with Lisa. I'm sorry. I don't think today is a snoozer because of that reset on economic growth.
I said the
we might have
rate
some experience of getting in trouble for calling something a snoozer in the past. Do you want to clarify and finesse what you said, Lisa?
I was saying the rate decision is probably going to be held steady. The meeting 45 minutes later, I can't even believe I'm going through this. You guys are just tweaking me, and I'm totally falling for it. But I think that Christine Lagarde will not be a snoozer, and it will be very interesting to see what she has to say. I'm riveted. John?
ECB PR are going to be really happy with everything you just said.
Good.
I'm in a good mood this morning. The weather in London, I've got to say, is absolutely beautiful. The sun is shining. It's one of those crisp mornings where you wake up in London and it's just...
He had a photo out, folks, on Twitter coming out of the, whatever it's called, that bar that stays open until 5 a.m., and there was a sunrise.
Are you crying because you weren't with me?
I got that right. It was so emotional. I didn't even know if the doors at the Ned were open.
He hasn't gone to sleep. He's still after, went clubbing and just came in, rolled in.
That's something new. Why don't we get started?
Okay, let's get to the price action. I'm going to do it right now. Equity futures today, a little bit negative on the S&P 500. We roll over. Let's give you a shape of the price action. Down 14 on the S&P, negative 0.4%. There's the euro. We saw what happened last week, a breach of 120. Chief economist didn't like it. Let's see what President Lagarde's got to say about it later. 118.39. Treasury yields unchanged. We are slap bang in the middle of the range since April 1st. The bottom end of the range, 50 basis points. The top end, 90 basis points. There we are at basically 70 on a US 10-year. So that's the price action cross-asset worldwide. Let's bring in our first guest of the morning, Troy Gaius, Skybridge Capital, the co-CIO. Troy, great to catch up with you, sir. First question, just jumped out in the note that my producer sent to me. You've become more defensive in the last couple of weeks. Why, Troy?
Yeah, well, look, as you recall, I mean, one of the major drivers of the explosive upside and basically all asset prices since the bottom of March has been massive expansion of the Fed balance sheet, right? So, they expand their balance sheet by over $3 trillion. That led to over 18% money supply growth in a 3.5-month period. But since then, money supply growth's been basically flat for 8 weeks, and the balance sheet's been flat for 12. And you juxtapose that against the fact that we got close to 24 times earnings in the S&P. That's not to say that markets can't go higher, but without support from the Fed and continued money supply growth, it's very hard to see meaningful upside. And then you looked at just about every chart, they were going mini parabolic, whether it was stocks like Apple or the broader NASDAQ. Yeah. And again, that doesn't mean the world's going to end, but you certainly have much worse risk reward now than you did even 2 months ago.
Yeah, the MIT guy doing fancy squared functions. It's way too early in the morning for that. Troy,
keep it real, Tom.
Troy, you are the most qualified guy here with Scaramucci on this because you see the hedge fund business with the uniqueness of Skybridge. There's lots of profit taking going on, lots of assumed SoftBank call option success. How bad has the carnage been among those on the other side of the trade that got this call option play wrong?
Well, look, actually in the equity space, that's been one of the standouts for hedge funds this year, in that, long-short equity is a strategy that struggled for years, mainly due to hyper-loose monetary policy, high correlations. But this year, you've had very significant divergence. I mean, it's been as simple as long tech and short anything else, and you've had a pretty good run. So there is some downside this month to managers that are focused on tech or healthcare or even broader long-short equity funds. But you've yet to see enough damage in markets to cause anywhere near the price action we had not only in March, but also in Q4 of 18, which was another very painful period for that strategy.
So becoming more cautious, does that mean that the rotation into cyclicals, into the less loved stocks, does that mean it's over?
Yeah, look, it's really hard to get overly bullish on cyclicals across the board until you see another round of fiscal stimulus, right? I mean, those stocks, just like, credit that's tied to the real economy, needs continued explosive growth. And it's very hard to see how we're going to get that without another round of muscular stimulus. And most market participants expected that by mid-August at the latest. And here we are, September 10th, and all we have is a slimmed down bill in the Senate. So, we'd be cautious on getting too aggressive on cyclicals until you see, the fine print on the next round of stimulus, whether it's 350 or a trill or a $1.5 trillion, that's going to be very meaningful for stocks that are much more tied to the real economy, which by definition are cyclicals.
Tom, just note, trill is trillions, and we are going to now be using that in our lexicon. Trill. It's very trill.
It's just so Troy.
Your daughter's going to be sending that over to you. Troy, what's going to be the defensive asset in this period of potential turmoil?
Yeah, look, so from our perspective, if you look at credit markets broadly, the residential housing market was in the best shape of all credit markets globally coming into this. Obviously had a setback with the pandemic and having, delinquencies go up a slight amount, particularly forbearances going from non-existent to 7%, 8%. But since then, you've had meaningful improvement, and you still have a chance to make, high single digits, potentially low teens returns if spreads tighten. And, the home prices are up 10 to 12% median, right? They're up, 3.5% case-shiller the last 12 months, and incomes are up 7%. So, when you think about risk reward, that's a very attractive cash flow stream, and it's going to be very hard to disrupt the housing market from here. I mean, even if unemployment doesn't drop to 5% by the end of next year and takes to the end of 2022, inventory is so tight. You're 3.1 months existing homes, you're 4 in the broader market. And clearly there's extreme demand. So, we think on a risk reward basis, particularly at a time after you've had such a huge run up in equities, and there's no money to be made at all in vanilla fixed income, that's a great setup right now.
No money to be made whatsoever in vanilla fixed income. Troy, just clarify, what is vanilla fixed income for you at the moment?
Yeah, so anything tied to duration, right? You said it before. We've been tied in this range of 50 to 90 basis points. The economy is recovering, and it's recovered much faster than people expected. But from here, it's going to be slow. So what is really going to drive yields meaningfully lower from here? We're pretty sure the Fed's not going negative. Even when they expand their balance sheet, that's going to be more about driving inflation higher, which should not be friendly to the back end of the curve. So very tough to make money in duration, whether it's treasuries or investment grade. And then if you look at high yield, high yield's basically a 5.7% non-loss adjusted yield. And even though default forecasts have come down the next 12 months from where they were, say, 3 months ago, you're still roughly expecting 10% defaults with an average loss severity of 70%. So, 5.7 minus 7 gets you to a negative yield at least the next 12 months. Now, that's not to say you can't have a little bit of spread tightening from here because you are 535 over. But the risk reward of high yield is not nearly as good as it was 2-3 months ago, where you had more room for spread tightening, even in a low yield environment. And you also had room for upside surprise to forward default rates.
Now, Troy, before we let you go, for our listeners on radio who have missed this, is that salt wallpaper behind you at home?
Yeah, it is.
Because I know a gentleman who's renovating an apartment who might like some salt wallpaper. If you could send
we were joking around off air that the bedroom background just doesn't work for your producers, so we got to go with something virtual that has a little pop to it.
Hey, Troy, it's certainly got that. Great to catch up.
Las Vegas.
Guybridge Capital. Hey, Tom, I think that would suit the new apartment for you. I really do.
I do. We could get all of our different guests and get all their backdrops and do a melange or a montage.
No.
That would be very on brand.
It would just say triple leverage cash fund over and over and over again.
Well, that looked good until yesterday. I mean, look at the pop.
Wallpaper.
You look at the pop yesterday. I mean, it's pretty good.
In cash?
Futures negative today. Coming up on this program, Frederic Ducrozet, bank Pictet and C, global strategist. That'll be up next, right here on Bloomberg Surveillance, with equity futures down 0.2 on the Nasdaq. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Joe Biden says President Trump willingly lied about the threat of the coronavirus posed for months. The Democratic presidential candidate spoke after the president's comments to journalist Bob Woodward were revealed. President Trump told Woodward in March he intentionally downplayed the severity of the virus in public to avoid panic. The interview was conducted for Woodward's book that's being published this month. JP Morgan has found that some of its employees improperly received coronavirus relief funds intended for American businesses. Bloomberg has learned the bank noticed that suspicious amounts of money had been deposited into workers' checking accounts. Some employees have been fired. JP Morgan isn't commenting. And wildfires in Northern California have transformed the skies over San Francisco. During daylight, there was only a dark orange glow. More than 24 major fires are burning in the state now. One has carved a 25-mile path of destruction through mountains and foothills. It's possible that thousands of homes and other buildings have been destroyed. At least 3 people were killed yesterday. And ByteDance is likely to miss a Trump administration deadline this month for the sale of its TikTok U.S. operations. Bloomberg's learned that new Chinese regulations have complicated negotiations with the 2 bidders, Microsoft and Oracle. China's government has told ByteDance that a review of a proposed sale will take time. And there's a deal to keep bankrupt retailer JCPenney open. Penny's lenders will team up with more landlords, Simon Property and Brookfield Property, to buy the chain. The rescue deal is valued at almost $1.8 billion. It would preserve about 70,000 jobs. Global news, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Let's suppose 10 years from now, when you say you might hang up your spurs at Netflix, what do you think you might want to do when you turn the ripe old age of 70?
I want to have my own interview show.
Well, I'm sure you could get that anytime you want one.
This is a step in the right direction. Perhaps it's a harbinger for more changes in the future, like the completion of the banking union.
Show panic. We're not going to show panic. And that's exactly what I did. And I was very open, whether it's to Woodward or anybody else. It's just another political hit job. But whether it was Woodward or anybody else, you cannot show
a sense of panic, or you're going to have bigger problems than you ever had before.
Another book, another defense from the President of the United States, 2 months out from the general election. The price action shaping up as follows. This Thursday morning, ahead of that ECB decision in around about 20 minutes' time, an FX market that shows a euro that's a little bit firmer going into this one. Euro dollar is higher, stronger euro to 118.34. Equity futures, though, a little bit of weight to this tape, Tom, right now. S&P 500 futures down 0.6%. You do not see that corresponding move, that bid you would expect in the bond market. Treasury's unchanged, Tom. About 70 basis points on a 10-year.
Be interesting to see how ECB changes or the economic data in the United States today. As we saw the president mention this hit job, Kevin Cirilli is our chief hit job correspondent in Washington, out on an endless book tour. And Kevin, to begin with here, the book by Mr. Woodward to me is decisively different because he did 18 interviews with the president. This makes it a remarkably different book. And as Greg Vallier mentioned this morning, this is not fake news. It's on tape.
4 days in January. I think that's ultimately what this election in terms of voters' minds made up on the pandemic is going to come down to. January 28th, according to Bob Woodward's new book, Rage, is when National Security Advisor O'Brien met with President Trump and said that this is going to be the greatest threat, the words that he used according to Woodward, the greatest threat that your presidency faces. Now, at the same time, World Health Organization officials were traveling to Beijing to meet with China President Xi Jinping. And then in the day or two that followed, the World Health Organization declared the highest level that they could. And then on January 31st, one day after the WHO declared that, is when the president restricted travel from China. So the confluence of events between President Trump and President Xi in those 4 days in January, and whether you criticize that or praise that, is what this election will be decided on, Kevin, for that.
Okay, but spin it forward. Is this book different enough to change the undecided, the 10 to 13, 14% out there undecided?
No. I mean, look, this is a book that has tapes, that has legs, that obviously has the clout of Bob Woodward coming behind it. But ultimately, once the debates start, I think that it will dramatically be focused on the economy and reopening. That's where the movement in the polls. But what Joe Biden did yesterday in Michigan was tap into the rage, for lack of a better term, that this book touches into. And so that's what you heard from him yesterday, in which he said, in Joe Biden's word, that the president did this on purpose.
Kevin, do you know of anyone that hasn't made their decision, developed an opinion on how they think the president of the United States handled this pandemic? Does anyone really need a book to make that decision?
No one in my life, but I think that
I don't know a single person.
Yeah, I think most people are dug in. I mean, and even if you go into Pennsylvania, battleground state that I always talk about, I grew up there. But people are really dug in. But it's a turnout election, unlike one that we've ever seen.
And Kevin, we have got to talk about the journalism here as well. Let's not give it a free pass. How on earth did you conduct these interviews? Interviews that I imagine people who knew about them thought they were explosive, bombshells, and then sit on them for 8 months. If you really thought the words of the president were out of line with what was happening in public, if you really thought that the president should have been doing a better job, why wasn't it in print in March?
Yesterday, I spoke with Matt Schlapp, who is a senior advisor to the president's reelection campaign. He said that he was wondering why the audio was leaked and questioned the timing as well of the book. But I got to be honest, here in Washington, D.C., Tom, you know this, it's kind of like a political tradition. Matt Schlapp used to work for former President George W. Bush, and he wrote a Woodward book, or Woodward wrote a book on him, and it was controversial. So it's Bob Woodward knows how to get those books with those presidents.
Kevin, there's a question you talked about turnout. How much visibility do we have into turnout when so much of it will be remote, will be vote from home?
Well, I think, and 2 points that I would make here is that first and foremost, the increase in mail-in voting, which of course there have been recent hearings on Capitol Hill with regards to the U.S. Postal Service and the Postmaster General, Louis DeJoy. A lot of questions about the timing of the results and whether or not there will actually be a result come November 3rd, or whether it will take days, dare I say weeks after. But secondly, in terms of the turnout, is where things get nuanced, because for all of the unrest and for all of the frustration that we've seen play out across the country and in cities throughout the country, will those protesters show up to the polls? And will the Trump coalition and the Trump base in rural America, will they turn out? And that, I think, is what the Republicans are really focused on here, especially when you look at a state like Minnesota, which the president lost by 2 percentage points in the last cycle. That's within striking distance. And so, a lot would have to go their way if the election were held today for battleground states.
Kevin, just to wrap this up and push ahead, today we're going to be getting some sort of vote potentially in the Senate on this skinny bill. It's going to be torpedoed, right?
Yeah, I do not think Speaker Pelosi will go and get her coalition on board with this. But either way, it's a benchmark, $500 to $700 billion of fiscal stimulus. Just that's now the lowball estimate here in Washington, D.C.
Hey, Kevin, great to catch up. As always, Kevin's already there, Bloomberg Chief, Washington correspondent. Tom, you caught up with, what was her name? Mrs. Trays over at Vader Partners. Forgive me for not remembering her first name there. Henrietta, forgive me. Sure. I love catching up with her.
When you come in at 5 a.m. from the cock and whatever, and I get it.
I know. Maybe my brain's starting to fade a little bit, Tom. But what she had to say on the election and the incentives, I thought were really, really important and very interesting. We've said repeatedly the election is an incentive to make sure something gets done down on Capitol Hill. What she had to say this morning, what Henrietta Trace had to say this morning, Tom, is that now all of a sudden, playing the blame game is good politics for both sides, for the Democrats and the Republicans as well. And that's a massive change in the last month or so.
Yeah, she was quite strong today, and really to go to the $2 trillion stimulus the Democrats would do if we get a President Biden, it's sharply removed from what you see from the Republicans as well. John, I know futures negative 19. I have trouble concentrating this morning, John, because, I'm trying to game the Premier League for Lisa, and I know on radio and television this has riveted our viewership. And, John, just all of a sudden, Sheffield United is a natural for Ms. Abramowitz.
I don't know about that. I think she's going with Arsenal, just to wind you up.
Well, Arsenal, that would be sort of a London venue, and we all go over to London to see you.
That would be North London.
Yeah,
the suspense will build,
it's
and you
a
will
derby,
wait.
Lisa.
Monday.
It's a derby, not a derby. But, Sheffield United, she's a giant Def Leppard fan, so it really works with Joe Elliott and all that.
Maybe.
I'll come in with the
25 minutes in, I'm fading. I need the hair of the dog, I think, just to get back up to speed ahead of the ECB in about 20 minutes' time. Beers on Tom Keane. Going into an ECB decision 20 minutes away. It's 12:30 in London. It's perfectly acceptable. This is Bloomberg.
work and live has been interrupted. Uninterrupted service is peace of mind. Kimmy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
This is Bloomberg Surveillance Live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. A couple of hours away from the opening bell in New York, the price action shaping up as follows for equity futures stateside. A quick sneak peek at the euro as well ahead of that decision 15 minutes away. Full coverage right here on Bloomberg. In the FX market, euro dollar 118.41. We are firmer by 1/3 on that currency pair. That is a stronger euro going into this decision, though still well south of the 120 we breached last week. In the equity market, Tom, futures down 17 on the S&P 500, negative 0.5%, just a little bit of a weight to the tape.
Yeah.
And 70 basis points is your yield on a 10-year. And as we've said, Tom, going back to April, slap bang right in the middle of the trading range on a 10-year for the last several months.
There's a thing here called synodal dampening function, and it shapes up 3 days in. That's what we've got, a massive down 3 days in a row, a big up yesterday, and we pull back negative 18 on SPX futures right now. John, I take your point that it's just sort of like there, and we'll see. But, John, do you think ECB will move the tape? I'm not so sure.
Oh, no idea, unless they surprised to the upside in a massive way and delivered more QE, Tom. I think that's what you'd need to get a global market response.
Yeah, John, let me bring up a headline within the many headlines, and this is the argument back and forth between the French and those at 57th Street and Fifth Avenue in New York. This is Tiffany and LVMH. And, John, this headline is extraordinary from the French. Tiffany did not follow ordinary course of business. John, this is getting nasty.
Yeah, and it will continue to get nasty as well. LVMH set to make the argument that the handling of the crisis wasn't good enough over the last several months and through much of 2020. Yeah. There will be accusations, we're hearing them this morning, and some reporting too, that perhaps LVMH might have lent on the government in France, Tom, to give them some cover to back away from this deal as well. We know there's some tension between France and the United States over the exports of French goods as well, and Tiffany and LVMH are caught in the middle of this right now.
And Lisa, not that I would know, but I think if you go from Tiffany's down the street past, how do you spell Gabbana, and then you get to Gucci, that's where the president of the United States lives.
Yeah.
So you wonder if he's going to weigh in here 1 block away.
You clearly have had no experience with that path whatsoever. I will say, I do wonder how much this crutch of U.S.-French tensions has been used, and this basically is all a valuation story. Yeah. Basically, LVMH wants to drop the price, and they'll probably get it. And I think that that's really the question. At what price are they back in?
Yeah, John, I got a question for you, which really goes right to this. Has Europe had the accommodation oomph that America has, from where you sit with all your years of covering Frankfurt?
When you mean accommodation, you mean financial conditions,
just monetary conditions. Has Lagarde done a Powell in giving Europe the monetary oomph?
Let's think about this deal. LVMH was able to come to the debt market and pay virtually nothing, Tom, on that debt to fund this deal.
Exactly.
This deal is right there in the heart of all of this. And I think you caught up with Peter Prate, the former chief economist, who I was lucky to spend some time with many years ago over in Frankfurt, who's still very dovish, of course. And he made the argument, Tom, forget interest rates. They've got to keep financial conditions loose. They don't have to drive the curve much lower from here, but they have to keep financial conditions loose. And I imagine that's objective number one for ECB President-Chief Christine Lagarde.
No question about it. And let's get to the next meeting, here, which is September 16th, for the Fed. Frederick Ducrozet with us from Bank Pictet, SCA, a global macro strategist this morning. Frederick, what is the accommodation in Europe? Is it Fed-like?
I wouldn't say so. Obviously, there are many differences, but as you just said, the main mission, I guess, today and beyond today's meeting is for the ECB to ensure that these very low borrowing costs remain in place, that the spreads between Italy, Germany, keep tightening essentially. And this is really mission number one. You want to avoid any communication mistakes, any missteps that would jeopardize what the ECB has achieved this year, which is Fed-like, I would say, to some extent, in terms of both lending to banks at very favorable terms and buying assets in markets, obviously.
You know, I look at this. What is your number one observation of how this will affect markets today? I'm not convinced she can sell markets on a major move. Do you disagree?
I agree with you. It's only because we got the Fed next week, and obviously the Fed is still in the lead. It's still having an influence on the ECB, also because the strategy review at the ECB has not even started. So they are a bit between a rock and a hard place about this. But it's also about the euro. It's about the currency, which is a big mover, a market mover since the last meeting, up 10% against the dollar, up more than 4% on a broad-based basis. And I think that's where the ECB's credibility will be tested. Can Lagarde actually hint at something that could at least cap euro appreciation? I doubt it, except if she hints at the rate cut, maybe.
Well, Fred, let's talk about it. It's like a schoolyard standoff. Someone shouted something, and the other person stands there and says, what are you going to do about it? And that's where the euro bulls are right now. What are you going to do about it? What can they do about it?
I mean, essentially, they're both right. If you hear Isabel Schnabel, a bit more hawkish last week, Philip Lane, the chief economist, much more dovish, both would agree that euro appreciation has largely reflected rising confidence in the currency. It's a good thing. It's something that the ECB doesn't need to address fully, I would say, only to the extent that it would lead to an unwarranted tightening of financial conditions. And this will be reflected in today's staff projection, so I guess that's another focus. Looking at core inflation forecast, it's the first time in the ECB's history that you have core inflation projected to remain below 1% throughout the forecast horizon. And that's not something that the ECB can tolerate. And if the euro is to blame, at least to some extent, then yes, they have to react.
Fred, you sound like a central banker. That was always my question when I went over to Frankfurt. Are we seeing an unwarranted tightening of financial conditions? Fred, what is an unwarranted tightening of financial conditions? What does that even look like?
You know it when you see it, especially in terms of the implications on the staff projections. You got slightly higher oil prices, lower yields, tighter spreads. Net-net, I suspect today would not make a strong enough case for the ECB to move because the net result would be probably marginal on the staff projections. But again, this comes after such a long, sustained, protracted period of undershoot in terms of the inflation target. That's something the ECB has to monitor. And we heard it from the chief economist a few days ago. It does matter. The currency rate does matter, probably when you reach 120. And my pain threshold, subjective pain threshold, will be closer to 125 for the ECB to act.
Frederick, aside from the FX questions about the euro and how strong it can get, there's a question of how many more tools in the toolbox the ECB has. I'm channeling my central banker as well. Jay Powell saying that they have lots. Is the ECB looking at potentially buying junk bonds or buying stocks sometime in the future? Do you expect them to signal anything about what those tools might be?
I think today you need to at least hear from Christine Lagarde that they are ready to step up the pace of PEPP purchases, so QE in the very near term, even before you make a decision on extending the program. Then you can include the reference to the exchange rate in the statement. By the way, it won't be at 1:45 Frankfurt time, but 2:30 because it comes with the full statement in that case. And last but not least, you can possibly, what they do usually to buy more time, task the internal committees to look into the options. What else could the ECB do? My preference always goes with the TLTRO, those refinancing operations for the banks, easing monetary conditions, financial conditions, and you could possibly lower their interest rates even further below -1%.
Frederick, you were talking about how they have to convince everybody that they're really accommodative in order to keep financial conditions where they are. They have to outdove the doves. Do you expect them to do that today, to basically skew more to the bearish side on the economy than perhaps conditions warrant in order to keep financial conditions where they are?
Yes, I do, although more on the inflation outlook than the growth outlook, because apparently we will have slightly more confidence as an assessment in terms of the economic outlook. But it is, as you said, I mean, I think it's a bit of a test for Lagarde's leadership as well. Everything seems to be flowing and going on very well since the March meeting among the executive board and governing council members. Now we've heard a bit of a mixed signal from Schnabel, Lane, and Lagarde has to position herself. She's an all, probably, yes. Neither a hawk nor a dove. But if I had to ask and guess, I would suspect that she errs on the dovish side still.
Fred, I'll kill the mood this morning. Are they going to ask about Brexit in this news conference? And if they do, where's the ECB stand on all of this?
I'm going to get up and walk away. I'm just going to stand up.
She might be hoping that she won't get the question. You know, it's an easy answer. Who knows? No one knows in the UK. No one knows in Brussels. For now, it's a difficult topic, but it adds to the risk. It adds to the reason for the ECB to be very, very cautious. Who knows what happens over the next few months after the US election, after the US Brexit deadlines. That's indeed a very important deadline to watch as well. And another reason for the ECB to be better safe than sorry.
Hey, Fred, great to catch up.
Fred, thank you so much.
Oh, Tom is still there.
Are you still with us, Tom?
Yeah, I came back. Somebody just drove off the Pennsylvania Turnpike outside Altoona. And come on, John, they're not going to bring up Brexit. Come on.
They could.
Hey, it's a 60-minute long news conference.
John, seriously, let's inform
believe me, when you're in one of those news conferences and you're at the end, and everyone's asked your question 10 times over,
totally.
You might throw Brexit out there.
John, this is really important for our American audience on radio and TV. Why is that press conference different than the press conference Michael McKee attends with Mr. Powell?
Well, I think the Federal Reserve has changed the news conference a little bit over the last year or so, but at the ECB there's been a tradition, particularly with President Draghi, to ask follow-up questions and maybe ask 2 questions, Tom. And I think there's always been a longer exchange between the ECB president and the audience in the room. That would be my take on things, Tom. I've always said that actually, and please excuse me for this because I might offend a lot of people, but I've always found the press bag in the room at the ECB, in the room on Threadneedle Street at the Bank of England, to work together a lot more in a way that the Fed and the press pack there don't. And that's always frustrated me, Tom. Being in the room at the ECB, being in the room at the Bank of England, if a good question is asked and you're not satisfied with the response, you will have another journalist from somewhere else follow up on the question for you and go again. I see that a lot more in Europe than I do in the United States, and to be quite honest, it's disappointing.
And Lisa, I'll provide cover for Mr. Farrow. Folks, he's absolutely correct. The difference between the press conference quality in Frankfurt and Washington is distressing, to say the least. John, what's distressing is we don't have a market to talk about. Turkish lira printed 7.50 twice this morning. Does that count?
That counts. This counts too. The euro firmer going into this ECB decision. Euro dollar at 118.37, up around about 1/3%. That's a stronger euro. An ECB decision just around the corner. And I have to say, a really interesting news conference potentially coming up in around about 50 minutes' time for ECB President Christine Lagarde. Got to tread that fine line between sounding confident and vigilant about the downside risk without making that euro get a whole lot stronger. Up later, Alberto Gallo, Algebris Investments Portfolio Manager, heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Rishka Gupta. It's another setback in President Trump's bid to focus his re-election campaign on anything but the pandemic. He's had to acknowledge publicly downplaying the threat of the coronavirus, even though he knew it was dangerous. The president told journalist Bob Woodward in March the virus was far more deadly than the flu. At the time, he was telling Americans not to worry. In Beirut, a huge fire has broken out at the port, a little more than a month after a massive explosion there. The Lebanese army said the fire is at a warehouse where oil and tires are stored. Last month's explosion killed more than 190 people, injured around 6,500, and damaged thousands of buildings in the Lebanese capital. And Tom Barrack built Colony Capital by buying distressed assets during a recession. But during the current downturn, Colony is selling brick-and-mortar properties as it reshapes its portfolio to focus on what it calls digital infrastructure. Barrack spoke with Bloomberg's Jason Kelly.
I've always looked at real estate for trading. I've never looked at real estate as permanent ownership because nothing's changed. In 60 years, look at the building we're in. Look at the buildings across the street. Many of them were built in the 20s. The streets were built in the teens. The tunnels were built in the late 20s. And nothing has changed almost in 100 years. So the ebb and flow of real estate values has always been challenged by functional, physical, and financial obsolescence.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
A decision from the European Central Bank 50 seconds away. The official guidance from Lisa Abramovich, the unofficial guidance maybe, is that the decision might be a snooze, that the news conference might be more interesting. Ahead of that, a stronger euro dollar. Hey, it's your trouble, Lisa. You deal with it. Euro dollar right now, 118.36. This is a stronger euro going into this decision. Here's how it will work. You'll get a stream of headlines about things like forward guidance, maybe the asset purchase program as well. You'll get the rate decision, then a little bit later this morning, stateside at least, the afternoon in Frankfurt, when that news conference starts, you'll get the statement from Christine Lagarde, Tom, and that will be followed by some forecasts as well. And we understand, Tom, here at Bloomberg, there might be some renewed confidence in those forecasts.
Yeah, there's no question about it. The euro, John, off the 2015. Remember, OMG, euros through parity. Weaker euro worry of 4.5, 5 years ago. We're up 13% euro strength off that 2015 weakness.
Let's get to the decision, shall we? Unchanged on rates. On the refi rate, 0%. On the marginal lending facility, 0.25 unchanged. Negative 50 basis points on the depot rate. I mentioned all the headlines. Here they are on the forward guidance and all that good stuff. QE will run until shortly before interest rates rise. Rates at present level or lower until inflation goal is near. They keep the pandemic bond buying program at 1.35 trillion. Of course, they will reinvest maturing PEPP bonds at least through the end of 2022. So as far as I can see, Tom, on the asset purchase program, no big changes here whatsoever, either on rates as well. The euro, as firm as it was, just rolling over a little bit. Euro dollar 118.40. It is all about the news conference in about 45 minutes' time and the statement and the forecast we get as well.
Do they have a 2% inflation target? I mean, you know, let's go back to Jackson Hole, which seems 6 months ago. But do they have an inflation target that's less because their potential growth is less?
They have a price stability target, which they define themselves as in and around 2%. My words, not theirs, Tom. And they might reinterpret that inflation target. Remember the strategic review at the Federal Reserve? The ECB is in the middle of that right now. We should get a conclusion to it at some point in the next 12 months. And I wonder if it starts to leak into the reaction function, so to speak. Because remember, for the Federal Reserve, Tom, they were also in the middle of a strategic review. And pretty much everyone went out there and already told you about it before the chairman actually finalized it.
And Lisa, the back end of this key headline, key rates to remain at present level or lower until inflation heading to target. That's very non-Fed, because the Fed is saying get to the target and beyond, where they're saying until heading. So I guess if inflation turns, Lisa, that's sort of an almost Germanic thing.
Yeah, well, you're starting to see actually a little bit of a rollover in German Bund, so perhaps that's the response. But Tom, more than the inflation target, I want to understand what central bankers are thinking about how they measure inflation, what are they factoring in, as well as how they assess what they've gotten wrong. They have consistently undershot inflation again and again and again. What makes them think that this time around they can get it going?
You there, John?
I'm here. Okay. I thought you were going to bring in Alberto Gallo there.
Oh, no. Oh, I'm sorry. I thought I was going to go back to you for another brilliant observation. Because, folks, to be honest
here... I don't have one right now.
John is really, really good at this on the ECB. He has earned this back in his youth. Right now, we go back to our youth, Alberto Gallo, with Algebris Investments, who's been just wonderful in giving us perspective, not so much on full faith and credit, but the fixed income reaction of Europe. And that is a very different fixed income market than it is in the United States. Alberto, how will the people of bonds, notes, and bills, how will they respond to what we see today, this Eurostasis?
Good morning. The bond world is sitting on very, very low yields today. Think about $80 trillion in bonds in the world, and only 5% of that are yielding over 3%. So there's $14 trillion of bonds that are yielding negative. Essentially, bond investors are sleeping on a dynamite pillow, and that dynamite is inflation. At these levels of yields, you can only lose lose money against inflation, you either do it slowly if bond yields remain where they are because central banks continue to keep yield curves flat, or you lose them quickly if there is a steepening. And I think here, what the ECB is telling us is that they have no rush to provide, to use more ammunition today. But think about what the Fed is doing, what the Bank of England is doing. These central banks are a lot more aggressive. So there is a competition going on for debasing fiat currencies, for debasing paper money. And eventually, you're right, inflation has not reached target in the past, but we may see new ways to try to get there, including modern monetary theory or what you would call helicopter money. So I think this risk is underestimated by the fixed income market and underestimated big time.
A dynamite pillow, Tom Keene. You ever heard it referred to as that?
No, you got to be poetic and Italian to do that. If I said that, it'd be stupid, but Gallo sounds like a genius. I love it.
Alberto, a dynamite pillow. Let's expand on the risk then. What are you doing to avoid them?
So if you're a fixed income investor who needs yield, you want to have some assets where you're beating inflation. And today there is areas where you still get high yields. If you're lending money to the transport sector, which may recover if there's testing, quick and immediate testing, then you're getting high single digits. You're even getting double-digit yields. So you want some more yields. You want some equities that have returns and cash flows linked to inflation. You want some gold. You want some real assets, essentially. Bonds have done really well in the last 20, 30 years. But history can't repeat itself if we start from zero.
Okay, but this is, Alberto, I don't mean to interrupt, Alberto, but this is really important and is really the first key conversation of this September season. What are the indicators you will see to begin to see a vector or trend towards lower fixed income prices and attendant higher yields?
I think the U.S. elections would be a turning point because you may have more of the same. So the status quo is more of the same, QE based on assets, corporate tax cuts, S&P goes up and the real economy doesn't benefit. So that's the status quo. But you may also have a change with a democratic government who wants to help more the people that need help. And so you may have more money to the different states, more money to schools, more money for education, and more benefits that go to the entire population. So what you would call, QE for the people or helicopter money. And, surprise, surprise, when you give money to people that don't have it, they actually spend it.
Really?
They don't do a buyback. They don't just push the S&P up. So instead of having asset inflation only, we could actually see a bit more, a bit more real inflation in that scenario. So that's going to be a turning point. And I don't think people are really prepared for it in the fixed income market, looking at where treasury yields are, and also inflation-linked assets more generally.
Well, Alberto, that's exactly where we wanted to go. Fiscal support. And in Europe, they seem to have a plan together that they have agreed upon, and they're going to be issuing EU bonds for the first time, joint bonds. BlackRock has come out and said that they want to buy those to get ahead of a potential rally and firming up of faith in the region. Do you agree with that? Do you see this as one way to get in on this potential growth and cohesion and change in fiscal stance in the Eurozone?
Europe has done a big step forward. It was probably a bit underestimated by the market. The European Recovery Fund, 750 billion euros for growth. It's getting close to a fiscal union. It's not there yet. There is further steps to be done. Still a small stimulus compared to the US. Now, inflation in Europe is still relatively far away from the US because here we have spending at 3%, 3-4%. Overall, and in the US, the deficit is double digit. So it's still small, but it's a big step to cap the downside. I'm more worried about inflation in the US and the UK than I am in Europe. The ECB has less, less incentive to be super proactive and continue ease. And we'll see what they say in the Q&A, but I don't think they will be extremely dovish.
Yeah, so Alberto, I saw, this is very important, I saw in the headlines a real nuance, the idea of inflation heading towards a higher level versus the Fed saying, well, wait till we get there. Is that the influence of the Bundesbank, where we're still worried about the turn towards higher inflation before the getting there of higher inflation?
I think at the moment, it's a bit like everyone is assuming that we won't get there, at least for a long time. So the Fed is telling you, we're going to keep rates at 0 for 5 years, and then you may have inflation exceeding moderately 2% for some time before we do something. And there you can see that vagueness when they use the word moderately and then sometime. It's a bit uncertain. They are leaving to themselves the option to do something, but they still see it as a relatively vague, relatively unlikely scenario. But this could change a lot if politically it becomes almost very difficult to withdraw help from families and from states. And if you think about the politicians that will have to withdraw help, that's going to be a really bad, very unpopular choice. So after elections, we could see more fiscal stimulus, and the debt monetization will continue. I think in the US, in the UK, and to a lesser extent also in Europe.
Alberto, love catching up with you as always. Alberto Gala there of Algebris Investments on an ECB decision and a global bond market. That news conference in 35 minutes' time. Tom Keene, can you define what an emergency is? Because the asset purchase program that was announced at the ECB was an emergency program. And for some officials on the governing council, once they decide that that emergency is over, they will push the idea that asset purchase program should end. There will be other people on the governing council that disagree, and it's the tension within that community that's going to play out publicly very quickly, very soon.
John, well said, including some of this paper going out to 2022. We're beginning to talk about 2022. John, I'm sorry, it's all about aggregate demand. It ain't there in the U.S., and it ain't there in Europe.
Disinflation, the trade that many people are behind, though. And I've got to say, Tom, it's a balanced argument now. A lot of people taking the other view. Not a consensus trade in the way it used to be. From London and New York, good morning to you all. This is Bloomberg Surveillance.
Kama donda kuna naweza kaa na mvi ama huyo mvi akatae nikae na yeye juu. Naona kila mtu anaogopa kukaa na ule msee mwingine, anaweza fikiria uko nayo, so bado distance. Lazima nibakishe kiti yangu kama mvi na kaa peke yangu. Lazima na sanitize pia, najiprotect na laptop before nianze kazi. Lazima ni hizo chuma za ndani zote lazima niziguze na kitambaa na sanitizer. Mask lazima ukuwe nayo kila time, juu kama hakuna customer anaweza ingia kwa gari.
We've tried to sanitize people, we scan the temperature as the passengers board the vehicles. But the challenge comes here when some passengers ignore, they don't accept, they don't wear the mask, so that's been a challenge. We used to carry a capacity of 32 passengers, but for now it's reduced to 15 passengers according to distance, social distancing, and this has caused us loss, because the passengers too are suffering. because of the fare charge that we have a little bit increased.
Investment bank merger is something we have been discussing actually for months. This is not a cost exercise. There will be some cost benefits, but it's really about having one underwriting business, to have one investment bank globally, one equities business.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
We're in a recovery, but this recovery is about to slow down.
The longer term is not looking good right now in terms of the support for consumption.
This time we don't expect the market to go down 30-40%. We just expect it to kind of trade sideways for a bit.
The structural unemployment rate depends critically on whether you have a vaccine.
We have not solved the source of the recession. We're still trying to figure it out.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Interesting press conference coming up with Christine Lagarde at the ECB. We've been looking at this all morning, looking at market reaction. John, a little lift in bonds, a little bit of higher yield off those ECB headlines, largely expected.
A lift in equity futures as well. I'm not sure it's related to the decision, though, Tom. Equity futures are off the lows, down just 10 points on the S&P, negative about a third of 1%. To take the temperature, maybe the success rate of this news conference a little bit later will be defined by just one currency pair. Euro-dollar right now, session highs, Tom, 118.44.
And, of course, euro strength there over the last number of years, getting up near the 120 level. We've got lots to talk about. We welcome all of you on Bloomberg Radio, Bloomberg Television, worldwide, across this nation, with a number of themes, particularly in the markets. And we're going to get to equities and derivatives here in a moment. On the NASDAQ whale, also the Gamma whale. And, John, we've got to go into this because the response on Twitter yesterday was on fire. The Premier League whale. I mean, they've done sports the best. Let's all admit that, as the MLB struggles towards a bubble. And the answer, John, is team surveillance is riveted by the opening of the Premier League season.
And Lisa is making us wait. She's making us wait as she makes her decision on who her team is. Lisa, do you need some guidance? Are you getting enough guidance, enough suggestions? Are you happy? Are you comfortable with what you're deciding?
I'm getting a lot of suggestions. I am looking through all of them. I am leaning toward a team. I am taking all aspects into consideration. In particular, given the fact that my household has a proclivity toward the Mets, as well as
this is not the Mets, Lisa.
I like teams that spend a lot of money but lose a lot, John.
Just in, John Farrow, Lord O'Neill emailing in and suggesting Man U for Lisa would be the way to go. I mean, not
Kit Jukes actually messaged in the last 24 hours and said Arsenal. So she's got a big decision to make, Tom.
Huge. So this is very big here as we go into the weekend, and it's great to see Premier League back again. They have done it better than anyone in this pandemic. One final note, John, before we get to the equity markets, and that is this pandemic, how it clouds everything, including the Woodward-Trump flap in Washington that we have. It affects Boris Johnson's life in the United Kingdom. It's a pandemic at a new stage. Barry Eichengreen, writing in Project Syndicate, John Farrow, that now is the important time for this COVID virus versus what we saw in the spring.
Going into flu season, Tom, it's going to be really, really difficult. And there's been, I would say, outrage here in the United Kingdom about the inconsistency of the policies that are coming out of this government. The new one is that you can only limit gatherings to 6 now, Tom. 6 is the limit.
Amazing.
And a lot of people thinking about Christmas. Which relative do you tell can't be at the party.
It's a great
It's not going to be a dinner. I mean, we can laugh about it, and it's a great excuse too, Lisa. But Tom, it's serious.
Yeah.
That's what people are thinking about. Front pages of the newspaper in the United Kingdom today is Christmas cancelled.
Yeah, I got to admit, folks, that took me back, to say the least. We're so proud of our team over Labor Day weekend, really working on the storm in the equity market. And we've been doing that with a mix of equity strategists, and particularly those with a derivative experience. Mandy Hsu joins us right now with Credit Suisse, our chief equity derivatives strategist. Mandy, just simply, is the unroll played out from the excesses of August?
Well, we'll see. I mean, all eyes on tech. So, obviously what everyone's talking about right now is the dislocation that we're seeing in tech vols. And to me, what really stands out, two things. So one is obviously the extreme levels that we're seeing, right? Tech vols currently are trading at a record high relative to the broader market. And that's true whether, you're looking at the index level, looking at the NASDAQ versus the S&P, or even looking at the single stock level, right? The FAN as a group, their implied volatility relative to the broader market is higher now than it was in fourth quarter of 18, which is, a period when the market sold off 20%, again, driven by tech. But the second thing I want to highlight is that, this spike in vol that we've seen recently, it hasn't really come from the last few days or the last week when we had to sell off, as you would expect. Most of that surge in volatility and implied volatility has actually come from the 2 weeks prior when the market was going up, and particularly when tech was going up. And that's quite unusual. So we saw a very pronounced spot up, vol up dynamic in tech. And I would say, in terms of what's been driving it, I would say two things. One is obviously on the way up, we've seen some incredible demand for upside calls, and that's been written about in the papers quite a bit. But the second, which probably has gotten less attention on why vols haven't really performed in recent days on the sell-off, we just haven't seen any demand for downside protection during the sell-off. People are very, very comfortable with what we're seeing right now. And in fact, the most consistent message I've been getting is that, this might be the most anticipated, most expected 10% pullback that we've ever gotten. So there really hasn't been a sense of panic in the market, despite some of the big moves that we've seen in tech.
So, Mandy, what does that tell you? That there's more downside? What does that mean?
Yeah, so right now what it means is the investors are still viewing this as a positioning cleanup in tech, right? Some of the excess in tech that we've seen build is getting taken out. They're not viewing this as a broader macro sell-off, right? And one way you can tell, like two things that stand out. First is that the volatility in equities in recent days really has not spilled over into other asset classes, right? So, rate vol, credit vol, FX vol, all, either flat or actually lower. And the second thing is within the equity market, what stands out is correlations are still very, very muted. So that is one metric to keep an eye on if you want to know if this is a macro sell-off or a sector-specific idiosyncratic sell-off. And right now, if you look at S&P correlations, both implied and realized, are trading around 30%. Put that in perspective, in June when we had, a pullback in the market, correlations were in excess of 80. Right. So right now, market is saying this is not a macro sell-off. It's very much tech specific. Doesn't mean that, it cannot turn macro. Of course it can, and we actually think, there are a couple of macro catalysts coming up that can pose downside risks to the markets. In particular, the ongoing fiscal stimulus talks and, of course, the U.S. election. But, right now, at least, the way that the market is trading and what it's been priced into the derivatives market is still saying this is very much about tech positioning rather than broader concern.
Mandy, you brought up the ongoing fiscal talks in Washington. What could potentially happen with that could disrupt markets, given the fact that it looks less and less likely that something will get through, and a lot of strategists have said that's priced in?
No, I would say the opposite. I think the consensus that something will get done. I mean, that's why you haven't really seen, a material pullback in the broader, the S&P. You have seen it in tech. But to me, I think the investor consensus is still something will get done. It might come, late, but something will get done. But to me, the risk is if it doesn't get done, right? Yesterday, I think there were a couple headlines saying that Republicans don't expect any type of further stimulus bill. So that is a risk. And we'll see, in terms of upcoming data, especially with regards to retail sales, how much the impact that has on consumption.
Mandy, Lisa emailed in earlier. Lisa, thanks for watching. About the synodal dampening function, and she really said, "What in God's name is that?"
We said we weren't going to do this. this.
Yeah, forget about the synodal dampening function. Mandy, just simply here, are we going to regress to the mean, or are we going to go to the mean, where you just go way beyond any kind of regression that we've got and we're surprised to the downside?
Are you talking about markets or are you talking about vol?
He's saying,
No,
is it going to be a big sell-off?
I'm talking about the markets.
No, I think, to me, the risk is biased to the downside. And what we've been recommending investors do, especially kind of given the macro, the calendar for the rest of the year, is to look at downside protection strategies that take advantage of the dislocations that we're seeing in the bull market. So particularly within the S&P, what really stands out is the steepness of downside skew, right? So there's a lot of downside risk being priced in, so you can take advantage of that through structure, for example, where you sell, buy one put and sell a further out of the money put, or other structures where you take advantage of that. So that's what we've been recommending. I do think it is prudent with markets, still near all-time highs, structures that take advantage of these dislocations, that give you some downside protection, really makes sense going into year end.
John Farrow, I think this is just great. We got Mandy talking about skew. She's doing kurtosis if we extend the interview.
Mandy, thank you for tolerating us.
Happy talking about kurtosis any day.
Mandy Zhu at Credit Suisse. I don't know how long I've been doing this program now, maybe too long, but the amount of times I've had to say thank you for tolerating us to guests. Tom, you are the only person I know on the planet that could say something, make it up, and nobody on Wall Street knows
they do. Come
if it's
on.
real
Bruno
or not.
DePere knows what I'm talking about. Truly the great derivative expert at Bloomberg, who invented so much of our terminal functions. This is really important, John, because it's about momentum. It's about you regress to the mean. We've got this up vector where everybody's happy, happy, happy. And do you go back to that at some point, some level, or do you blow right through it to recent lows? John, when was the last time we really experienced a sustained 6-month, 12-month difficulty in the market? It was a long time ago.
Well, Lisa's best friends sorted that out, didn't they? The central bankers, Tom. And isn't that the story?
Friends?
They just didn't let this one rip.
Totally agree.
I mean, I'm being slightly sarcastic, Lisa. I'm well aware they're not your best friends. They didn't let this one rip. Look, maybe that was the good news, that they stepped in and they kept financial conditions loose. But I think what it's done, and we've gone back to this story so many times, what it has done, if your sole objective is to divorce financial conditions from underlying fundamentals, if that is your objective, then you are going to see a widening spread between Main Street and Wall Street. And you have to acknowledge that some societal tension will develop from that. And one thing I haven't heard enough of from central banks is just an acknowledgement of that, Tom, that's happening.
This is so important, what Mr. Farrow just said, folks, and what this comes down to on radio and television is simple. When you hear all this fancy mumbo-jumbo like gamma, what that means for the average person worried about their retirement plan is that gamma means instability. And, John, that's that lack of trust that you're talking about.
Hey, Tom, if you're lucky to have a retirement plan, and isn't that the problem? We talk about, the 401ks and the amount of money going into them and how equities have recovered and all of that good stuff. So many people, Tom, do not have a retirement
Pushing
plan.
up
So many
70%.
people do not have skin in this game.
Yep.
If you've got skin in this game, you're doing okay. And that's been a story for the last 10 years. Financial assets have done wonderful. What about everyone else? What about the people that don't have money in this market? From New York and London, this is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. In Beirut, a huge fire has broken out at the port, a little more than a month after a massive explosion there. The Lebanese army said the fire is at a warehouse where oil and tires are stored. Last month's explosion killed more than 190 people, injured around 6,500, and damaged thousands of buildings in the Lebanese capital. JP Morgan has found that some employees improperly received coronavirus relief funds intended for American businesses. Bloomberg has learned the bank noticed that suspicious amounts of money have been deposited into workers' checking accounts. Some employees have been fired. JP Morgan isn't commenting. And ByteDance is likely to miss a Trump administration deadline this month for the sale of its TikTok U.S. operations. Bloomberg's learned that new Chinese regulations have complicated negotiations with the two bidders, Microsoft and Oracle. China's government has told ByteDance that a review of a proposed sale will take time. And wildfires in Northern California have transformed the skies over San Francisco. During daylight, there was only a dark orange glow. More than 24 major fires are burning in the state now. One has carved a 25-mile path of destruction through mountains and foothills. It's possible that thousands of homes and other buildings have been destroyed. At least 3 people were killed yesterday. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Some things you see coming. Some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This data over the past couple of quarters, I hate to say it, it really doesn't matter. And it will start to matter when we learn about the growth trajectory.
That was Henry Peabody, a defensive. Great to catch up with him in the last 24 hours. When will it matter? He's looking for Q4, Q1 2021. Let's get the price action, shall we? In the equity market, around about 1 hour and 13 minutes away from the opening bell stateside. Equities all over the place in the last week. Down aggressively, bounced back down again. Off the lows, though, down just 8 on the S&P 500, negative 0.25%. Your euro session highs going into that news conference, 12 minutes away. Euro dollar 118.51. Treasuries unchanged at about 70 basis basis points, call it 0.71% now. Claims 12 minutes away as well. US data, Tom, before we get to that news conference, we will break down the economic data in the United States of America.
I'm so glad, John, you brought that up in the blur of the news today. I've completely forgotten. We see claims, and boy, that's an important data point as well. Right now, we want to get to this important interview. The Johnson family runs Fidelity, and they've always done inspired hiring around the street to bring in the troops with the Boston bread. They did that 2 years ago with Vadim Zlotnikov, who was definitive at AllianceBernstein. If you were on the street, you had to read the quantitative and market letters and research pieces from Mr. Zlotnikov. He joins us now with Fidelity, their institutional asset management president. Vadim, the rules have changed. Fidelity's lived it, Schwab's lived it, everybody else has lived it. I want you to first discuss the overtrading disease we have right now. Are you in Fidelity facilitating an overtrading disease that will lead to losses and ill return?
Look, Fidelity has always been about long term, and you know as well as I do, 85 to 90% of the investment outcomes comes from the underlying product design, not from the trading. And the emphasis has always been on making sure you have the appropriate product design to achieve the particular investment goals.
Very importantly in your heritage, and this goes back to the great Paul Hondros as well, Fidelity has had a mandate to be on prospectus. What is working right now in terms of total return? Narrow on prospective investment or a more broader tone?
The last 10 years have been very much about a very narrow market. 60-40 product that emphasized U.S. equity at the expense of international equities has delivered very, very strong results. The key issue is this going to change? And we believe that it will, and that there are a number of drivers that are conspiring to argue for significantly greater degree of diversification as we move forward. That is going to be, we believe, a critical decision. And just to be absolutely clear, I'm not speaking on behalf of Fidelity, but rather on behalf of my group and the economic research team that developed the paper.
Vadim, build on that a little bit and move away from the 60-40, because it's the 40 that has got a ton of attention in the last month or so. Can you speak to that, Vadim?
Absolutely. So look, one of the basic premises we have is that you want to invest on the basis of something that is at least knowable or at least very likely about the future. And the one thing that is very likely is that the levels of debt in the economy relative to GDP are going to continue to escalate. Demographics, policy, everything is conspiring to make it happen. The issue is, and this is where really the big question is that going to drive inflation? And we believe it will. That is a huge departure from where we've been in the past. Not only will it drive inflation, it will also alter the type of assets that are likely to outperform in that environment.
Okay, so what's likely to outperform?
So there are a number of things. So first of all, one of the interesting things, if you look back at before even 2003, luxury goods had the same essential inflation as the CPI. Following 2003, and if you remember the aspirational consumer, using your house as a checking account, all of those cliches that we've had drove massive inflation in luxury goods. Likewise, we've seen asset inflation. The future inflation is going to be somewhat driven by the policy. For example, to the extent we start to see policies aimed at wealth redistribution, narrowing the income inequality gap, many of the areas that have high elasticity to the lower end consumer spending are likely to see inflation. They've been left for dead, they're undervalued, and we do think some of those could outperform over a long term. This is not a one-year forecast.
Vadim, this will be a question for you at AllianceBernstein, and certainly with you at Serious Money at Fidelity. When we read about the Gamma whale, when we read about the NASDAQ whale, when we read about fancy derivative strategies, it destroys trust on the street. How do we regain the trust on the street if everybody's trying to outdo SoftBank of Japan?
Yeah, look, there will always be investors that are interested in shorter horizon trading, that believe they might have a point of view on things like Gamma or Delta. Honestly, that is a relatively small minority. I do see, it is happening. It is, I think, a function of significant liquidity we see in the market as well as low interest rates. So there is a propensity to try to seek out incremental investments. I really want to keep coming back to the point. If you really believe the statement that 85 to 90% of your outcome is about product design, that's where people should spend 85 to 90% of their time.
Vadim, I just got an email in. All anybody wants to know is, how does Will Danoff do it? What's the Danoff message that has made Contrafund do that for all these years?
Hard work and natural talents. Those are generally pretty good recipe for success. He's done a remarkable job. It's truly, truly inspiring. I believe it's his 30th year at Fidelity this year, so it's been a remarkable run.
It's been a remarkable run. I want you to take us back to George Vanderhyde and Jeff Vinnick and the rest of them, who from time to time would make bets in the bond markets. Are your equity guys using zero coupon bonds and such to make big bets now on fixed income, or is that from the past?
I think that's mostly from the past. I think, look, there are so many products at Fidelity. There may be somebody doing investing in some bonds, but no, that's within the group that I run, which is really what I'm most familiar with. We don't do that. No, it's mostly multi-asset products, balanced products that are aimed at satisfying a particular investment outcome, particular regulatory requirement, particular tax requirement.
Vadim, fantastic to catch up. Good to see you again. Vadim Zlotnikov there, Fidelity Institutional Asset Management President. Allow me to lift the lid on this program just for a moment. In the commercial breaks, Tom will speak to a guest and literally has the org chart of a company from 20 years ago memorized and just reels off every single manager's name of the last 20 years and asks the person if they remember that individual. Tom, can you just write a book?
No, I can't write a book. No, we talked about it, and one of the mayors of New York said, no, you're not going to write a book.
He said no. Did he? Do you want to tell us which mayor?
I can't remember right now. No,
let me get to the price action this morning as we await jobless claims a little bit later this morning, 5 minutes away. Tom, I'd read the book.
Maybe I should do 18 tapes.
I'll do what you do. I'll do what you do. You'll get the book, you'll open it up, pick a random page, and pretend you've read the whole thing. Equity futures off the lows this morning from London and New York.
Oh.
I'm not joking. This is Bloomberg
Got
Surveillance.
up on the wrong side of bed. Waited, he can go to bed.
Let's suppose 10 years from now, when you say you might hang up your spurs at Netflix, what do you think you might want to do when you turn the ripe old age of 70?
I want to have my own interview show.
Well, I'm sure you could get that anytime you want one.
We know it's a pandemic, and we want to be very responsible for pricing. We plan to underprice this vaccine for its value, especially in the pandemic phase.
Live in London and New York, this is Bloomberg Surveillance. A couple of things on the agenda in the next couple of minutes. We will get you initial jobless claims in America. Then we will cross over to Frankfurt, Germany to catch up with President Lagarde as that news conference commences. They will start with the press conference and the statement as always. We'll cross over there in a couple of minutes' time. We need to get to jobless claims in America. To do that, as always, we get the numbers from Bloomberg's Michael McKee.
Thank you, John. Well, we are looking at a non-seasonally adjusted claims of 857,000. That's up from 837,000 the week before. So jobless claims rise by about 20,000. We're using the unadjusted numbers now because, of course, they changed the way they did the calculation of seasonal factors for the headline numbers. Headline numbers come in at 884,000, exactly bang on what it was last week. So no change in the adjusted numbers, but the non-seasonally adjusted numbers rise by more than 20,000. Pandemic assistance, we've got to keep watching this one because this is the freelancers out there. Yeah. 839,000 basically. That is a change of about 100,000 higher. So we are seeing definitely a rise in unemployment claims as the month of August goes on and into September. This is the headline number for the week of September 5th, right, and the pandemic number for the week of September 5th. The number of the total number of people who are getting claims, 29,605,000. That's an increase of 380,000. So we are seeing definitely a big increase in initial jobless claims.
Mike, 30-year bond moves here up 2 basis points, 1.47%. We'll see what the rest of the market does. Futures negative 9. Michael McKee, when I look at the data here, I go to Heidi Shearholz at the Economic Policy Institute, who just minces no words. Look at the data, and then just as you correctly say, layer on that pandemic assistance statistic as well. When you do that, what do you see?
Well, what you see is that we're seeing more and more people file claims. Now, the interesting thing about the pandemic number is it is so big and it is still rising. And it was pointed out this morning to me that California is responsible for about half of all of the pandemic emergency assistance, the freelancer money claims. And so you have to wonder if there is something wrong with California's reporting system or if that many people are out of work. Now, it is true that in California, not only did we have a spike in COVID, but we've got these terrible fires that are closing down businesses and in some cases burning up entire towns. So there is probably a reason for some of those additional claims. But some economists have suggested that not just in California, around the country, we have seen some fraud in the unemployment insurance filings, given how old all the computer systems are. And that is something that is probably going to have to be looked into. I want to also pass along here, PPI is out, and it's up 0.3%. Ex-food and energy, the core, is up 0.4%, and the final demand for services rose 0.5%. That's a fairly large increase, same as it was in August. Margins for final demand trade.
Hey, Mike, great to catch up. Great work as always. Michael McKee there of Bloomberg. We have got a lot of news all at once. We start with the euro dollar up 0.7%. A green light seemingly from the European Central Bank, said to agree there is no need to overreact to euro gains. We will wait for that news conference and the questions on that. That Q&A session will begin very shortly. Tom, typically I'd head straight over to Frankfurt and go straight over to President Lagarde. There is some really important news crossing from Citigroup. I go back to Davos, Switzerland. You and I sat down with Mr. Corbett of Citi, and we asked him a simple question about whether he would be proud stepping aside and allowing the first female CEO of a Wall Street bank. That is set to happen at Citigroup. The CEO, Michael Corbett, planning to retire in February 2021, selecting Jane Fraser to replace him, heading up the consumer division, the consumer banking division. Tom, it won't be a surprise to many people that it's Jane Fraser. Many people believe this would be the person that would take over from Mr. Corbett, but there it is in print for all to see.
Well, it's interesting to see, and this is a real change. And again, Mr. Corbett, at 60 years old, would be rather young. He is a legitimate football player. He's one of the few guys in college sports, John, that was really, really quite good at Harvard years ago. Corbett, of course, coming in off of Vikram Pandit and all of the train wreck of 2009, the reverse split that Citigroup went through. Jane Fraser, John, who you know better than me, out of Scotland and out of Cambridge and out of McKinsey, is really, really seasoned for her age.
Historic day for Wall Street and much more coverage still ahead. We have to cross over to a news conference with ECB President-Chief Christine Lagarde with the euro at session highs at 118.80. Here's the President of the European Central Bank.
As necessary to reinforce the accommodative impact of our policy rates. We intend to continue reinvesting in full the principal payments from maturing securities purchased under the APP for an extended period of time past the date when we start raising the key ECB interest rates, and in any case, for as long as necessary to maintain favorable liquidity conditions and an ample degree of monetary accommodation. We will also continue to provide ample liquidity through our refinancing operations. In particular, the latest operation in the third series of targeted long-term refinancing operation, TLTRO 3, has registered a very high take-up of funds supporting bank lending to firms and to households. The monetary policy measures that we have taken since early March are providing crucial support to underpin the recovery of the euro area and to safeguard medium-term price stability. In particular, they support liquidity and funding conditions in the economy, help to sustain the flow of credit to households and firms, and contribute to maintaining favorable financing conditions for all sectors and jurisdictions. At the same time, in the current environment of elevated uncertainty, the Governing Council will carefully assess incoming information, including developments in the exchange rate with regard to its implications for the medium-term inflation outlook. It continues to stand ready to adjust all of its instruments as appropriate to ensure that inflation moves towards its aim in a sustained manner in line with its commitment to symmetry. Let me now explain our assessment in greater detail, starting with the economic analysis. Euro area real GDP contracted by 11.8% quarter-on-quarter in the second quarter of 2020. Incoming data and survey results indicate a continued recovery of the euro area economy and point to a strong rebound in GDP growth in the third quarter. Alongside a significant rebound in industrial and services production, there are signs of a notable recovery in consumption. Recently, momentum has slowed in the services sector compared with the manufacturing sector, which is also visible in survey results for August. The increases in coronavirus infection rates during the summer months constitute headwinds to the short-term outlook. Looking ahead, a further sustained recovery remains highly dependent on the evolution of the pandemic and the success of containment measures. While the uncertainty related to the evolution of the pandemic will likely dampen the strength of the recovery in the labor market and in consumption and investment, the euro area economy should be supported by favorable financing conditions, an expansionary fiscal stance, and a strengthening in global activity and demand. This assessment is broadly reflected in the September 2020 ECB staff macroeconomic projection for the euro area. These projections foresee annual real GDP growth at -8% in 2020, +5% in 2021, +3.2% in 2022. Compared with the June 2020 Eurosystem staff macroeconomic projections, the outlook for real GDP growth has been revised up for 2020 and is largely unchanged for 2021 and 2022. Given the exceptional uncertainty currently surrounding the outlook, the projections include two alternative scenarios, which we will publish on our website following this press conference. Overall, the balance of risks to the euro area growth outlook is seen to remain on the downside. This assessment largely reflects the still uncertain economic and financial implications of the pandemic. According to Eurostat's flash estimate, euro area annual HICP inflation decreased by -0.2% in August from +0.4% in July. On the basis of current and future prices for oil, and taking into account the temporary reduction in the German VAT rate, headline inflation is likely to remain negative over the coming months before turning positive again in early 2021. Moreover, in the near term, price pressures will remain subdued owing to weak demand, lower wage pressures, and the appreciation of the euro exchange rate, despite some upward price pressures related to supply constraints. Over the medium term, a recovery in demand, supported by accommodative monetary and fiscal policies, will put upward pressure on inflation. Market-based indicators of longer-term inflation expectations have returned to their pre-pandemic levels, but still remain very subdued, while survey-based measures remain at low levels. This assessment is broadly reflected in the September 2020 ECB staff macroeconomic projections for the euro area, which foresees annual inflation at 0.3% in 2020, 1% in 2021, and 1.3% in 2022. Compared with the June 20 Eurosystem staff macroeconomic projections, the outlook for inflation is unchanged for 2020, has been revised up for 2021, and is unchanged for 2022. The unchanged projection for inflation in 2022 masks an upward revision to inflation, excluding energy and food, in part reflecting the positive impact of the monetary and fiscal policies measures, which was largely offset by the revised path of energy prices. Turning to the monetary analysis, broad money growth continued to rise, reaching 10.2% in July 2020 after 9.2% in June. Strong money growth reflects domestic credit creation and the ongoing asset purchases by the Eurosystem, as well as precautionary considerations which foster a heightened preference for liquidity in the money-holding sector. In this environment, The narrow monetary aggregate M1, encompassing the most liquid forms of money, continues to be the main contributor to broad money growth. Development in loans to the private sector continued to be shaped by the impact of the coronavirus on economic activity. Following strong increases in the early month of the pandemic, the annual growth rate of loans to the non-financial corporations remained broadly stable in July, standing at 7%, compared with 7.1% in June. High rates of corporate loan growth continue to mirror elevated liquidity needs of firms to finance their ongoing expenditures and working capital, and to further build liquidity buffers, although the rebound in economic activity has resulted in some recovery in their revenues. The annual growth rate of loans to households also remained stable at 3% in July, the same rate as observed since April 2020. Growth in loans to the private sector continues to benefit from historically low bank lending rates. Overall, our policy measures, together with the measures adopted by national governments and European institutions, will continue to support access to financing, including for those most affected by the ramifications of the pandemic. To sum up, a cross-check of the outcome of the economic analysis with the signals coming from the monetary analysis confirmed that an ample degree of monetary accommodation is necessary for the robust convergence of inflation to levels that are below but close to 2% over the medium term. Regarding fiscal policies, an ambitious and coordinated fiscal stance remains critical in view of the sharp contraction in the euro area economy. Fiscal measures taken in response to the pandemic emergency should, as much as possible, be targeted and temporary in nature. The three safety nets endorsed by the European Council for workers, for businesses and for sovereigns, amounting to a total of 540 billion euros, provide important funding support in this context. The Governing Council also strongly welcomes the next generation EU package of 750 billion euros, which has the potential to significantly support the regions and sectors hardest hit by the pandemic, strengthen the single market, and build a lasting and prosperous recovery. In order to fully reach its potential, the package will need to be firmly rooted in sound structural policies, conceived and implemented at the national level. Well-designed structural policies could contribute to a faster, stronger, and more uniform recovery from the crisis, thereby supporting the effectiveness of monetary policy in the euro area. Targeted structural policies are particularly important to revitalize our economies, with the focus on boosting investment in priority areas such as the green and digital transitions. We are now ready to take your questions.
Okay, the first question today comes from Balázs Korányi at Reuters. Balázs.
Good afternoon. President Lagarde, your words indicate to me that the exchange rate was a topic of discussion in the Governing Council today. So could you give me a bit of detail about that discussion, and how concerned are you about the current level of the euro? Do you think this strength is justified, and how much does this affect policy? Second question is about whether you discussed any change to any of your policies, whether it's the PEP or APP, TLTRO tiering. Was there any change being discussed today?
Thank you so much for your question. Yes, indeed. The Governing Council discussed the appreciation of the euro. But as you know, we do not target exchange rate. Our mandate is price stability. And clearly, to the extent that appreciation of the euro exercise negative pressure on prices, we have to monitor carefully such a matter. And this was indeed extensively discussed during our Governing Council. On your second question concerning changes to our programs, we, as always, look at how effective and efficient our policies are and our purchase programs have been. So when we look at the impact that a program like the pandemic emergency purchase program has been, we can only acknowledge the fact that it has been efficient and it has been effective. Whether you look at the sovereign yields across the euro area, whether you look at all indicators of fragmentation, you can and we certainly did take stock of the fact that it has worked in relation to both stabilization of financing conditions and in respect of the risk of fragmentation. In addition to that, clearly in terms of monetary stance, we also acknowledge the fact that PEP has also served its purpose, although initially it was not intended for that particular aspect of our monetary policy, but it did. So we decided to maintain our monetary policy, to maintain our accommodative monetary policy, and certainly under current circumstances, it is very likely that the full envelope of PEP will be used for the purpose of developing those policies.
Okay, the next question comes from Isabella Buffacchi at Il Sole 24 Ore. Isabella.
Thank you for the opportunity. President Lagarde, I have two questions. The first is on PEP. The ECB does not fix the size of its net purchases programs in relation to the size of government bond issues. However, what you called the ambitious fiscal measures in response to coronavirus pandemic by the euro area member states will result this year and next year in a massive increase in debt GDP levels, adding pressure on debt sustainability in some countries. Are you and the Governing Council worried that public debt increases might jeopardize financial stability and provoke unwanted tightening, higher yields and spreads? So in that sense, the markets expect the PEP to be increased. And what do you think about market expectations on that front? My second question is on banks. The take-up of the last TLTRO III tender was, as you said, very high, but it also showed a fragmented banking system and some weaknesses. COVID-19 can increase fragmentation and weaknesses in banking, and so markets expect more to be done for banks, for example, softening the TLTRO III conditions. Is the Governing Council looking at that on European banks in pandemic and possible revision of existing rules or tools? Thank you.
Well, thank you very much for your many questions. Let me take the opportunity of your first question to first of all acknowledge and celebrate the fiscal measures that were taken. We had repeatedly over the course of time asked for fiscal measures to be taken and for fiscal policies to work hand in hand with monetary policy. This is clearly something that we have seen since mid-March, both at the national and at the European level. If you combine all the fiscal measures that were taken at national levels, you arrive at roughly a number of 4.5% of GDP, consisting of measures that really have an impact on the outlook. And that is not to mention the measures that were taken under the headline of guarantees, which roughly account for about 20% of GDP. That's only at the national level. As I said in the introductory statement, the Governing Council strongly welcomed not only the 3 safety net measures that were decided earlier in the summer to help both employees, companies and sovereigns in total amount of 540 billion euros. But it did really welcome strongly the breakthrough of the new generation EU fund of 750 billion euros, which clearly will have an impact, most of which, by the way, is not included in our projection as they are being published today. So these fiscal measures were necessary, and I'm only pleased that they could be taken in due course and sometimes with the necessary waivers and exemptions that were required at the European level. Let me just add a few words about the program that we put in place, the pandemic exceptional emergency program. And let me remind you that it had two functions. And it was initially calibrated for 750 billion euros. That was back on the 18th of March. And the dual function was the following. The first function was to stabilize market, to ensure a smooth transmission of our policy measures. The second function was to ease our monetary policy stance to help counter the substantial downgrade of our inflation outlook caused by the pandemic. The PEP announcement already in March and its recalibration later on in June have successfully stalled the tightening in financial conditions and contributed to easing the overall monetary policy stance. And, clearly with markets stabilizing and risks of fragmentation subsidizing, I remind you that we are pretty much back to the pre-COVID levels in terms of both spreads and dispersion of yields. The flexibility property of PEP, which is distinct from the attributes of the CSPP, for instance, has become less prominent. And the role of the PEP in easing our monetary policy stance has taken a central stage instead. So, in a nutshell, fiscal measures were needed. They were taken rightly, timely, and efficiently. The PEP, as an emergency program, was clearly responding to the needs at the time. And I would add that the TLTRO that you've referred to has also served the purpose that we intended, which was to make sure that the economy was receiving abundant liquidity in order not to accumulate liquidity, not to build buffers, but in order to make sure that lending to the economy was taking place. And TLTRO 3 was calibrated with that in mind. So if banks can actually access a borrowing interest rate which can go down to -1%, it is only under the condition that the lending to the economy, corporate and households, is actually tantamount to what it was, or more than what it was, prior to COVID-19. And, TLTRO 3 is very different from TLTRO 1 and TLTRO 2 in terms of take-up. We've observed at the time of this massive take-up for the first operation, roughly 1 trillion and 300 billion euros. We've observed that it was very well spread throughout the euro area. So it wasn't country-specific. It wasn't a category of banks in a country. It was across the board. The other thing that we have observed, which tells us that it is effectively working, is, number one, the low interest rates, which continues to apply, both for corporates and for households. Number two, the increased credit that is lent to the economy, +7% for the corporates, +3% for the households. And the fact that the banks themselves, in the July bank survey that we have, I think, published, actually say that TLTROs has helped them to lend to the economy. And it shows in the numbers. Those banks that have taken up TLTROs have actually a larger proportion of loans to the economy than those that did not take up TLTROs. So in this sort of stock-taking exercise, both in relation to PEP, in relation to continued asset purchase programs otherwise, and in relation to TLTROs, we believe that our monetary policy tools, as calibrated, have worked well.
Okay, next question is from Bloomberg News and Carolyn Look. Carolyn.
Hi, good afternoon, President Lagarde. My first question is about some recent comments by Philip Lane, in which he talked about a two-stage policy approach to the PEP. So he said its role is to counteract the negative shock to the expected inflation path caused by the pandemic. How widely is this view that ending PEP will depend mostly on the outlook for inflation rather than just the immediate crisis effects shared among the Governing Council? And my second question is about the Fed's recent strategy shift, where a lot of attention has been paid to the change in its inflation goal, which is in itself something you might have some thoughts about, but it also introduced an important shift in how it assesses the health of the U.S. labor market, paying more attention to how marginalized groups fare in the economy. So I'd like to know what efforts the ECB is making to better understand the unique inequalities facing minority communities in the euro area's labor market. Thank you.
Well, thank you very much. I think I have just actually addressed the point that you are raising, which is the dual function of the pandemic emergency program. It was a program in and of its own, and it had in its DNA, as I think I have mentioned at one of our last press conference, flexibility, which was clearly intended to address the issue of dispersion, the risk of fragmentation, and intended to make sure that our monetary policy was transmitted across all member states of the euro area. And clearly that function has worked, is working, and is critically important in order for our monetary policy to actually transmit throughout the whole region. It has a dual function in that the other function has to do with the monetary stance. And clearly it will continue to address and deliver on that dual function. And we very much hope that it continues to work on both accounts, both the stabilization of financing conditions, the risk of fragmentation, but also the monetary stance in order to make sure that inflation is going towards the medium-term objective that we are pursuing. As you know, we increased the size of PEP back in June, and that was clearly intended to respond to the circumstances and to make sure that all the consequences resulting from the pandemic could be addressed through that pandemic emergency program, whether it related to fragmentation, to financial instability, or to the monetary stance that was a direct consequence of pandemic. So that continues, and we've extended, as you know, the duration of our purchases, as well as indicated the time frame during which we would continue to reinvest. And we also indicated that all of that should not in any way predicate any obstacle to our delivery of monetary policy. Now, your second question, which is a broad one, has to do with the strategy that has been developed with a bit of a lag time attributable to the pandemic by the Federal Reserve Board. And clearly we have noted, as you have, that the dual mandate, price stability and employment, that the Fed pursues have been revisited. And you have commented upon it, and we have taken good note of those changes. As far as we at the ECB are concerned, we had started our strategy review. Just like the Fed, we pressed the pause button during the time of the highest level of the pandemic crisis, and we are about to resume. Actually, our next seminar, which will focus on inflation measurements, is due to be held on September 23rd. And this whole period of COVID-19 has not stopped the work stream, the 10 work streams that have been assigned specific research and analytical themes from working. So we feel that we are up and about and ready to, as I said earlier on, turn every stone that will help us define our strategy in order to make sure that the ECB is fit for purpose and our monetary policy can deliver. So trust us, we will be working on our strategy. I think it would be totally unwise and not loyal at all for me to already prejudge what the strategy review deliberations will be. There's an enormous amount of work that is being done, but there will clearly be a focus on our definition of price stability. It's a cornerstone of any strategy of any central bank around the world, and we will be extremely attentive and focused on that. Thank you.
Okay, the next question is from Christian Siedenbiedel at the Frankfurter Allgemeine Zeitung. Christian.
Yes, Mr. President, I would like to know, do you think we will get deflation now in the Eurozone?
I couldn't. Can you repeat your question?
Could we get deflation?
Oh, deflation.
Do you think we will get deflation now in the Eurozone?
Well, you know, according to Eurostat's flash estimates, inflation decreased to minus 0.2% in August from plus 0.4% in July. And that decrease, which, you know, hit the front page in some corners and was argued about, reflected a drop in inflation excluding energy and food, as well as lower food inflation, which were partially offset by less negative energy inflation. Overall, energy inflation remained a drag on headline inflation, but with less negative rates since June, still reflecting the oil price drop in the outset of the COVID-19 pandemic. Food inflation, in contrast, increased sharply in April, but this surge has since unwound and movements have normalized again to usual seasonal patterns. Inflation excluding food and energy declined as expected to 0.4% in August. And why is that? Well, it is due to the temporary VAT German decrease and to the postponement. I'm sorry that I'm going into details, but that's what it is. It's the postponement of garment sales in two of the major countries of the European Union from July to August, and also to weak consumption demand. Clearly, the September 2020 projection that will be published shortly do not foresee deflationary risk. And it would not be a good economic analysis or inflation analysis to conclude that because of one measure or 1 month of negative result, we are heading towards deflation. To the contrary, actually, deflationary risks, which were slightly higher back in June in our latest projections, have receded in September. So I know it's a bit of a circumvoluted way to address your question, but I wanted to do that because the minus 0.2% in August was a bit of a wake-up call for some. We don't think that it is actually descriptive of a situation that we are interested in, which is the medium-term evolution of inflation. And those deflationary risks identified previously have actually receded. Thank you.
Okay, the next question comes from Ilias Siakantaris of Prototema.
Thank you very much, Mr. Steen. Good afternoon, Madam President.
Good afternoon.
I would like to revisit, can you hear me?
Yes.
Yes, I would like to revisit a theme that I read back in December, but comes back strongly, as this is not your usual recovery. It's not just about sectors restarting. The pandemic has hastened a structural shift in the economy, wiping away whole sectors like retail and travel and leisure, and bringing forward new ones, technology, e-commerce, healthcare. But this type of transition takes time until these sectors are mature enough to boost employment and output. Therefore, the output gap will grow and will remain wider for longer. Is there an enhanced role the monetary policy can play to facilitate this transition? For instance, can the ECB take a more active role to promote the needed types of investments through the bank lending channel, or by targeting purchases of assets that would help drive more investment to certain sectors of the economy that have stronger growth potential? And do the banks in the Eurozone, especially in the periphery, need a special extra attention or support in order to cope with their capital challenges, as well as with a lower demand for credit? Thank you very much.
Well, thank you so much. And I have to say that I agree with your analysis of the changes that we're seeing. It is a crisis like no other, and it is a recovery that is very specific and very unusual as well. But let me also say that the mandate of the European Central Bank is price stability. So to the extent that we can contribute to economic development by securing price stability, this is our way to share the mission and the duties that we have in order to restructure and reorganize the economy in order for it to grow to the benefit of all. Second, let me also mention that the way in which the New Generation EU Fund has been decided, and the special focus that has been given to the green and digitalization dimension of the investments, seem to us to be exactly the right determination in order to respond to the challenge of restructuring the economy. If that, in terms of investment, is coupled with the right economic structural reforms in order to make sure that there is good leverage of those investments, then certainly the response to the challenge will be strong. I would like to mention another way in which, well, two other ways in which we contribute our share under our mandate to the restructuring and the recovery of our economies. The first one is using an instrument like TLTRO in the volume that it has. This is clearly intended to fuel credit to the economy, to make sure that operators, whether they are families or enterprises, can actually have access to credit and can participate in the recovery of the economy. Second, under our various purchase programs, as you know, we have an allocation that is dedicated to public institutions. So to the extent that the European Commission, either directly or through other entities of its choice, issues bonds and raise financing, then certainly it would qualify as a public institution, the bonds of which we could buy. So it's not that I'm looking forward to it, but it is also our way to participate in the effort that will be a much more collective effort under these new instruments that were decided over the course of the summer. Thank you.
The next question comes from Annette Weisbach at CNBC.
Thank you very much, President Lagarde. I have a question about your comments on the strength of the euro. You're saying that you have discussed it extensively, but at the same time, you and the ECB don't seem to be overly concerned about the strength of the euro. So was that you shared the old policy members or makers, I should say? And then another question on Brexit. The ECB has called on banks to make serious provisions now for Brexit. So what do you think will be the dominant scenario for now, and what are you calling on banks to do?
Well, thank you very much. I think I've been quite clear and quite explicit in the introductory statement concerning the role that the appreciation of the euro plays, and I will refer you back to page 3 at the top of the page, where we say, at the same time, in the current environment of elevated uncertainty, the Governing Council will carefully assess incoming information, including developments in the exchange rate, with regard to its implications for the medium-term inflation outlook. As a good observer of our introductory statements, exchange rate and the appreciation of our currency was not mentioned in previous documents. So that is clearly an indication of the fact that we do not target, but we monitor, and we monitor carefully, because obviously the appreciation of our currency has an impact on our inflation. And as I said, it's not a policy target for us. And I'm not going to comment on the level of our currency, but it is clear that the external value of the euro is an important determinant of price setting in the euro area. So we will continue to monitor the development and be very attentive to them. I think you had a second question, which had to do with Brexit.
Brexit, exactly.
Yeah. You know, Brexit, I think, for quite a while has been included as one of the downside risks attributable to geopolitical development. And that is included in our projection. Clearly, we are not in the negotiating seat. The negotiations are handled very ably by Michel Barnier under the mandate that was assigned to him by the European Council. We are carefully monitoring as well the developments. We very much hope that after the Brexit that was decided and became effective as of January 1st, 2020, the outcome of the negotiations, notwithstanding the negotiation posturing and what has been observed in the last few days, will lead to a positive outcome so that the projected downside risk that we have included in our projection will not be made worse. Thank you.
Thank you very much.
The next question is from Tom Fairless at the Wall Street Journal.
Hi there. Thanks for taking the question. Yeah, I guess I had a follow-up on the exchange rates question. You were quite clear that the ECB is looking at it closely, but I wondered if you could say anything about whether the development so far has been basically benign, or if it's something that is worrying most members. And the second question was on the possibility of cutting interest rates. It seems as though most of the focus has been on the PEP and how that would be the main tool if you needed to provide more stimulus. But could an interest rate cut be helpful? I think investors are pricing a small interest rate cut. Do you think that could be helpful to support the economy in the kind of shorter term? Thanks.
No, as I said, the European Central Bank does not target exchange rate. Our mandate is price stability. And to that end, we have a medium-term inflation aim, which we try to pursue using all the monetary policy tools that are available. It is clear that we are currently observing through the analysis that we do, we're observing negative pressure on the price level, and that is partly attributable, largely attributable actually, to the appreciation of the euro. So while we don't target any level, and I do not, and will not comment on any level, we are also monitoring carefully the appreciation of our currency in relation to its impact on our inflation medium-term level. On your other question, let me take this opportunity to remind you that if and when necessary and warranted by circumstances and in accordance with our mandate, the Governing Council is determined to use all the policy tools that it has available and to deploy them and calibrate them as necessary and as appropriate in order to deliver on our mandate. And that applies to all our policy tools. So I did mention the particular impact of PEP, because that is the most recent development that we've had, recalibrated back in June. I did refer to the APP, and to the targeted long-term refinancing operations, because they were also the latest one. But it doesn't mean to say that I'm excluding all the other tools that we have available. And indeed, if and when it was needed, we will not hesitate to use the tools as appropriately and as adequately as is needed. There are circumstances under which asset purchase programs are more efficient in order to reach our goals. There are circumstances where interest rates are more efficient. We have considered for the last few months that the asset purchase programs was the right tool in order to reach our goal. Thank you.
Okay, the next question comes from Andres Stumpf of Expansion, please.
Good afternoon, Mr. President. Two questions, if I may. You have mentioned that it's very likely that the full envelope of the PAPP will be used, even with the rebound on the economic activity. Do you think that we will probably see another increase on its volume before the end of the year? And my second question is about the Spanish banking merger that involves CaixaBank and Bankia. I would like to know your opinion about it and whether this was the kind of concentration that the ECB was looking for, or if it is another lost opportunity for a transnational operation. Thank you very much.
Well, thank you so much. Let me tell you that we have not discussed any expansion of the envelope of PEP, and you're giving me a very nice opportunity to hand the floor over to my colleague, Vice President de Guindos, because your question clearly relates to a topic that he's even more familiar than I am about. Please.
Well, thank you very much, President. As you are fully aware, we do not enter into any kind of assessment or evaluation of concrete operations. What we have made is a generic recommendation based on financial stability considerations. And one of the main vulnerabilities that we have indicated in the past, and most prominently after the pandemic, is the low profitability of the European banks and the low valuations that this low profitability is given rise to. So consolidation is one of the instruments. It's a generic call, a generic recommendation, as I have said before, in order to improve the profitability of the European banks, to get rid of excess capacity and to reduce the cost structure of the European banks. But we do not have any sort of concrete comment with respect to very specific or particular operations as the one that you have mentioned.
Okay, thank you. The next question comes from Annalisa Piras of Taglicht Media.
Good afternoon, Madam President. I would like to know, what do you believe is today missing in the architecture of the currency union? And the second question, what do you believe would it take in the next 5 years to have a fully prospering euro area?
I think we have said for a long time that for the currency union to be more complete and its architecture designed to the full possible extent, we would like to see a fully developed banking union with all its attributes, so that there is, a euro area banking system with easy cross-border mechanism, with resolution mechanisms, with a backstop facility in place, and with much more solid principles of a union than we have. Second, I think we've also consistently indicated that we would like to see a capital market union, which would apply throughout the euro area at least, and that would facilitate access to capital by enterprises and large corporates without the discrepancies and the different regulatory regimes and filing requirements that currently apply, in order to make sure that money actually flows to where it is needed in order to finance investment. I think we clearly also are pleased to see that there is at least embryonic joint fiscal capacity that was decided COVID-19 in order to facilitate convergence and competitiveness and hopefully investment on a cross-member state basis throughout the euro area. I would mention those three key components in order to strengthen the currency union that we have. And I'm delighted to see that under the presidency of Pascal Donoghue, we have a convergence of view on some of those items in order to support the euro area and make it a stronger player on the European scene.
Okay, the next question is from Martin Arnold at the Financial Times.
Hello, Madame Lagarde.
Hello.
Can you hear me? Hello. Could I ask a bit more about the strategic review? There have been some suggestions that you maybe should look to speed up the strategic review, especially after the Federal Reserve announced the results of its own review and adopted a more dovish stance. Could you perhaps split the strategic review and decide on the inflation target first and then come to the rest of it later? Second question, do you detect and are you worried about signs of divergence in the economic recovery of the Eurozone? Thank you.
Thank you very much. On our strategy review, as you know, we had to pause for a little while because of COVID and because of the necessity to actually concentrate all the brainpower and all the forces of the ECB on devising those new tools and making sure that we could actually respond to the objectives that we had. And we are now resuming our strategy review with the appropriate sequence of seminars, with reactivated work in the various work streams that have been identified. And let me just give you, I know that you're probably familiar with it already, but mention for all the audience the various work streams that we have, because I think it really demonstrates the scope of our review and the depth that we want to develop in so doing. So we will cover topics like inflation measurements. That's an important one that is often debated. That's coming up on September 23rd. We will also work on ECB's price stability objective. As I said earlier, it's one of our key focus. Eurosystem modeling, very important in order to identify whether we are capturing all the right ingredients and whether we are working them out in the adequate way. We will also discuss digitalization and the impact that it has from a monetary policy point of view, and I have in mind obviously such matters as the payment system, the euro digital currency possibly. Our topics will include climate change. As those who listen carefully to me, it's a topic that I'm very keen about, which I believe has a systemic dimension that applies actually to price stability. We will include also financial stability and macroprudential policies, non-bank financial intermediation, communication, and the interaction between monetary policy and fiscal policies. Now, I have limited illusion about the absence of leak in all the work that will be done. But my hope is that we can have sufficiently cohesive a process so that we can actually, as we move along, possibly signal directions without actually settling on any particular final considerations, because all these topics actually interact and will matter when it comes to defining our overall strategy. So that's really what I wanted to say about our strategy review. Added to which, there will be a public dimension to it, because we will have, inspired by the Fed process actually, which itself was inspired by the Canadian Central Bank, we will have an outreach that will really include as many stakeholders as possible, ranging from NGOs and civil society to obviously members of parliament, and particularly the European Parliament, with which we will have a constant dialogue. On the issue of divergence, I think that's what I tried to say when I used the words uneven, incomplete, and uncertain. And as a result of these three components, we are likely to see divergence. We are seeing divergence, actually, depending on how bad countries were hit by coronavirus, depending on what fiscal position they started from, depending on how much fiscal space they had available, depending on the strength of their banking sector, and so on and so forth. What we are hoping is that the European Union instrument that has been decided, the New Generation EU Fund, will actually address some of those divergences and dispersions within the euro area and within the European Union as well, in order to direct as much as possible of the funding, particularly in terms of grants, to those countries that are that have been most hit and that are likely to come out of the process with less recovery than the others. And I think that the flexibility that we have embedded in PEP is also a tool that we have used in order to help in that process. Thank you.
Okay, and that brings us to the end of today's press conference. We're out of time. Thank you very much.
Can I just say one thing? And that's en français. Je voudrais juste évoquer un instant la mémoire de Antoine Rufnac, qui était un homme d'État et dont l'enterrement a lieu précisément aujourd'hui, à l'heure où je vous parle, et qui était quelqu'un qui comptait beaucoup pour moi. Merci.
That wraps up the news conference in Frankfurt, Germany, with ECB President Christine Lagarde. From New York and London, good morning. Good morning to you all. Let's get to the price action, shall we, as we approach the market open in New York City. We have to start with the FX rate. Euro dollar through 1.19. How many times have we heard this from a central banker? We do not target foreign exchange, but it matters for our price stability mandate. Well, it only matters to a euro bull right now if you can back it up, tee it up with a credible policy option. And right now, the ECB doesn't have one. For the ECB chief, this was always going to be tricky. How do you simultaneously upgrade your GDP forecast and at the same time emphasize the need for more accommodation? Euro strength, the story off the back of this. Session highs coming out the other end of that news conference. Switch up the board. Into the bond market we go. A quick look at the Italian bond market very, very briefly. Yields were coming in earlier in the session. Right now on the 2-year, we're down just a basis point to a negative 11 basis points. If you get to the equity market at the opening bell for the US session, the equity market starting to build up in the last hour or so. S&P 500 futures positive by about 0.4%. The DAX up by 0.2%. I get a price action stateside as we get those opening prices for you in New York. We'll get to Abigail in just a moment. Let's start with Christine Lagarde. Again and again and again, she was asked the same question about the euro. And again and again and again, she gave this response.
We do not target, but we monitor, and we monitor carefully, because obviously the appreciation of our currency has an impact on our inflation. And as I said, it's not a policy target for us. And I'm not going to comment on the level of our currency, but it is clear that the external value of the euro is an important determinant of price setting in the euro area. So we will continue to monitor the development and be very attentive to them.
ECB President Christine Lagarde in Frankfurt, Germany, in the last 60 minutes. We can cross over to Brussels now, the heart of Europe, with Bloomberg's Maria Tadeo. Good morning, good afternoon to you, Maria. Your takeaway, please.
Well, what I would say is those comments on the euro, the market was very hot on that, was very keen to hear whether or not she was concerned about the euro. And she kept repeating, as you point out, this is something that we did look at, that we do monitor, that we care about, but we don't target. And Jonathan, I'm not sure about you, but I didn't hear anything that looked like she was even trying to talk down the euro. And that's the reaction that you're seeing in the market. I didn't hear anything that looked like, oh, this is Christine Lagarde almost trying to get a hold of that FX exchange. And then the second thing I would really highlight is those economic forecasts. So she's saying the economy could go both ways. It depends on coronavirus, and we have seen a number of new cases here in Europe, but it's the inflation outlook that I would say it's a real highlight, because she says, I'm not concerned about deflationary pressure. We think there's going to be an uptick in inflation, but that totally contradicts the data that we've had with that record low core inflation print. So there's a real gap now between the expectations from the central bank and the data that we have. And a bigger debate now, of course, as to whether or not the exchange rate, which is flying through the roof today on those, well, I would say lack of comments, does hurt the European recovery, because we know it hurts the exports. It removes momentum from countries like Germany. So at one point, is that going to become problematic for the European recovery, which is already very fragile? And we see a lot of downside risks going forward, from the politics to the economic policy.
Maria, the story of the FX market, as you know, though, it's about confidence, and it's about confidence in the Eurozone project. That's why we've seen a stronger euro, tighter spreads on the periphery, confidence being boosted by the fiscal effort over in Brussels, where you are right now. When it comes to policy, Maria, is it still more about Brussels and less about Frankfurt?
Look, I would say so. There was no indication there that we are going to see an increase into that pandemic line. She did say, however, and I think this is really crucial for the peripheral countries, for those yields, to say that we do intend or do believe that we're going to fully use the PEP program. She did mention that. That was a new line on the policy front. But again, there was that reference to the fiscal policy, this huge recovery fund that has been approved here in Brussels, but still needs to be approved by national parliaments. And the money, that is the key for countries like Italy, Spain, and so on. That needs to be paid out, and it won't happen until 2021. And of course, you have Brexit, which again, it's becoming incredibly complicated, and that is a big risk for the European economy, again, in particular for countries like Germany that do need that clarity and that do need to make things, but also sell them to other countries.
Maria, thank you, as always, for an update from you from Brussels. Bloomberg's Maria Tadeo, tremendous reporting, as always. 4 minutes into the session in New York, things pick up once again. We were down earlier on S&P 500 futures. At a cash open, a nice little lift, up 0.6% on the S&P 500. Back in the driving seat, the NASDAQ up by a little more than 1%. Abigail Digital will be with us very briefly, a little bit later in the program, to get you the price action from the market desk. In the FX market, it is a stronger euro, a 119 handle. This is what Invesco's Alessio De Longis had to say. The ECB will just have to live with a stronger euro. If that's sustainable and fundamentally justified, it should not be a major problem. Alessio joins us right now. Alessio, build on that for me, please. Your thoughts?
Look, I think you are absolutely right. What you mentioned earlier, the euro is rising as a result of improving political and economic fundamentals. From the ECB perspective, I think this is their angle. It's important to remember the euro is not expensive. The euro is moderately cheap according to many valuation metrics. It's probably in line with fair values. Let's say up until 125, there is really no red flags here, or even 130 to stretch it. So if the euro rises when it's fundamentally justified, and cheap, there is very little you can do to resist it, first of all. Most importantly, I would highlight one point. If the euro is rising in the context of a broad-based dollar depreciation cycle, that means that most currencies are rising against the US dollar. That means that the euro trade-weighted index is unlikely to rise very strongly, which means the impact on inflation may actually be more muted than we would have expected. And finally, dollar depreciation cycle typically coincides with global reflationary cycles, higher commodity prices and stronger global growth, which would only be a good outcome for the Eurozone.
Alessio, ultimately what matters is not what you and I think of this euro, it's what the ECB does with policy. Do you think there will be a policy response from the ECB at 119, 120? Last week we saw Philip Lane, the ECB chief economist, quite clearly make out what he thinks about a euro at 120. Didn't like it. But for euro bulls who believe they've just got a green light to keep on going, keep on climbing, as far as they're concerned, there's no policy follow-through to come from this. Is that the right approach, Alessio?
From my perspective, up to a certain level and speed, the right policy approach is probably to do nothing. I have to agree with this approach because, look, the speed that we've seen in the last 3 months of a 10% move on the dollar exchange rate and about 5% on the trade weighted, that's clearly outsized, and that's what they are monitoring, so to speak. That's what they're concerned about. But can we expect another 2 or 3 quarters of these kind of magnitudes? Obviously not. If that were the case, something is clearly going on that is unsustainable. That would make me worried. But a stabilization of the euro and a euro gradually continuing its bull market and heading towards 130, let's say over a course of a 18-month period, I would consider that fundamentally justified. And in some sense, I would actually welcome it, to your point, as a sign of strong confidence in the Eurozone project and the fact that the euro begins to have better fundamentals.
Alessio, let's get to the trade then. If you believe the euro's got better fundamentals, do you want to play that exclusively through the FX channel or elsewhere?
From my perspective, we are at the beginning of a multi-year outperformance cycle for developed market equities outside of the U.S. and emerging market equities. So it's not only the equity trade, the foreign exchange trade, in my mind, is also the equity trade. And actually, over the long term, these two tend to have positive correlation. So the idea that a rising euro has to necessarily hurt European equities versus U.S. equities, you can find evidence of that in short-term correlations, but the long-term cycles tell you the opposite. 2002 to 2010, rising euro outperformance of non-U.S. equities. From 2010 to today, falling euro outperformance of U.S. equities. So I think the broad macro trend is one of reflation into non-U.S. assets.
Alessio, great to catch up with you. Good to see you. Alessio De Longis there of Invesco. The price action 9 minutes into the session. Equities looking good. If you like international, look away because right now US tech is very much on top. The Nasdaq up by more than 1%. The S&P advancing 0.5%. From the market desk with the stocks to watch, here's Abigail.
John, well, that rebound that you're talking about for the major equities indexes here in the U.S. really is gaining steam, especially for that tech-heavy Nasdaq, as you were just talking about, on the day up more than 1%. The S&P 500 up about 0.6%. So it looks like the 50-day moving average test that we saw over the last few days is holding at least right now. The Nasdaq headed to its best 2 days since April 14th. As far as some of the movers that we're taking a look at, RH absolutely soaring. Restoration Hardware up 22%. They put up a big quarter, the best day since March 24th. And it looks like the high-end furniture company really benefiting from lockdowns, the home improvement trends. They beat adjusted earnings by 44%, revenues by 1.2%. So clearly a margin story, the street liking it quite a bit. Lots of positive commentary out there. Now, Peloton shareholders are hoping something similar will happen. This stock is now up about 18% in 3 days into its earnings report today after the bell. Let's see whether or not they can produce perhaps another stay-at-home darling. Penn National popping up 12%. This as the game company shares were started with a buy and a street high price target of $80 over at Rosenblatt. The firm is citing the potential for online sports betting plus the Barstool partnership. To the downside, though, John, we have Fuel Cell down 9.3%. They put up a third quarter EBITDA loss that was wider than estimates. There's a 16% bear short interest, so that may have something to do. And then finally, let's take a look at the shares of Citigroup, because of course there are some big news out today. At this point, popping nicely higher, up 0.8% as Jane Fraser has been named CEO. This will start in February of 2021 as current CEO Michael Corbett will step down. And Fraser, as you know, John, is the first female CEO to be named as CEO at a major bank.
Some major news on Wall Street with a nice Scottish connection. Abigail, thank you. 11 minutes into the session, equities picking up. Coming up on this program, the Senate voting on whether to advance a slimmed-down Republican stimulus bill. That conversation coming up next with Michael Purvis, Talbot and Capital Advisors CEO. From London and New York with equities positive, this is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
14 minutes into the session stateside this Thursday morning. Good morning to you all. Equities advancing 0.6% on the S&P. Turned the last week upside down. The Nasdaq back on top, up 0.9%. We add a little bit more weight to that index on the year, up another 107 points. That's the story of the equity market. Here's the story in Washington. Markets focusing on Washington, with senators preparing to vote on the latest Republican stimulus package, appearing to be dead on arrival. Senate Majority Leader Mitch McConnell saying Democrats are holding out until the election.
Republicans put forward a serious framework, but Speaker Pelosi and the Democratic leader refused to talk unless the starting point was their literally absurd $3.4 trillion far-left wish list. Washington Democrats have just kept trying to run out the clock until November.
Senate Minority Leader Chuck Schumer expecting political pressures to force Republicans to start making some compromises.
If we defeat it, there's a decent chance they will come back to the table and we'll get a much better bill. That's what we're hoping for. If they come back and meet us in the middle, we'll be eager to talk to them.
And the blame game continues down in Washington. Joining us now is Bloomberg's chief Washington correspondent, Kevin Cirilli. Kevin, here's the story for me. Over the last 6 to 8 weeks, you and I have talked about this continually, and we've talked about the election being an incentive to get both sides around a table to get the job done. In the last couple of days, I've heard a new argument, that the election is still an incentive, but this time around, for political reasons alone, it's an incentive to carry on blaming each other and do nothing.
Yes, exactly. But look, I think that the opening bid, or the latest opening bid from Senate Majority Leader Mitch McConnell, in which the Senate is going to be scheduled to take up in just under 2 hours, will really lay down a marker of sorts. And whether or not it happens before November 3rd, we really don't know. Based upon my reporting and in conversations that I'm having with staffers up on Capitol Hill, if this doesn't get over the finish line by the end of the month when they have to pass a short-term government funding bill, then likely the next round of fiscal stimulus will come after the election. It would be incredibly unlikely that it would fall before then. Now, emboldening the Republican argument that less stimulus is needed, less fiscal stimulus is needed, is these new revised GDP estimates. Take a look in the terminal where the Atlanta Fed is now predicting that there could be as much of a 30% increase in GDP growth as it relates to this quarter. We're going to get those numbers, of course, in a few weeks. But either way, Democrats are going to say that those estimates are not the type of models that we should be looking at. But either way, from a down ballot perspective, Jonathan, it is really just only emboldening rank and file conservative members that this massive form of government spending isn't needed at this particular moment.
Kevin, I've asked you the same question for 2 months now. I'm going to ask it again. We've said it's a matter of when, not if. Just in the last couple of minutes talking to you, it sounds like you're questioning the if now.
No, I want to be clear. I think that I think if it comes before November 3rd is diminishing. But I think that there will likely be some type of fiscal stimulus, that there is an incentive. I mean, because for Leader McConnell and even for ultra-conservative members, I'm thinking of Congressman French Hill, a Republican from Arkansas, who was on the task force in terms of looking at the bipartisan task force in terms of looking at the implementation of the last fiscal stimulus. Even someone like him, who is incredibly conservative on fiscal matters, is suggesting that more stimulus is needed. It's just a matter of the timetable, and it doesn't appear that the stars are aligning for a pre-stimulus before November 3rd. But in the lame duck, all bets are off.
Kevin, I guarantee this is the only conversation you'll have all day without talking to me about a book release. So run away. Kevin Cirilli down in Washington, D.C. You will hear a lot more from Kevin on a certain book release. No doubt about that. Talkback's Michael Purvis continuing to see upside in equities, but flagging another risk coming out of Washington, D.C. He writes the following: I'm bullish on equities until year end. With election risk overstated in terms of outcome, the real risk may not be the winner of even a Democratic sweep, but that we simply might not know who the president is come November 4th. Michael joins us right now. Michael, you're not the only one thinking about this, so tell me what it means for markets.
Well, I think just to step back for a second, you know, we've been talking a lot about the NASDAQ volatility being very elevated over the last few weeks. But if you step back and think about U.S. equity volatility, simply the VIX is at a premium to every other major equity market volatility. It's at a premium to Japanese equity volatility, European equity volatility, and emerging market equity volatility. And typically, the VIX is at a discount to those levels. In fact, it's at a, you know, it's sort of in the bottom 1 or 2% of all those spread readings over the last few years. So, you know, your prior guest was talking about, you know, sort of outperformance in foreign markets over the next few years. Well, right now, the U.S. is an outperformer in implied volatility levels. And I think that comes down to two key factors, one of which is simply that, you know, the big cap tech stocks, which you can really only find in the United States, have put in a massive rally. The NDX was up 35% year to date. It's the only major index to have that kind of outperformance. Many foreign indices are you know, either up modestly or down on the year. So investors have been hedging into that rally, which is, I think, constructive. But of course, the other thing is what Kevin, your colleague Kevin, was just discussing, which is both the you know, there's a big if and when questions on fiscal stimulus, and that's bleeding into the VIX curve into Q4, and of course the election here right now. And I think one of the things that I've been watching is, you know, there's various ways to measure the election risk premium in the VIX curve. You know, typically you might look at the October contract that captures November 3rd, that spread to November. And compared to any of the prior election years, you know, I was looking at the data from, you know, September 9th of 2016, 12th, and 2008. By any metric, we are highly inflated right now. The question is why are we inflated in that premium? Is it because, you know, a Democratic sweep, you know, would pose, you know, ugly market factors upon us? That could certainly be part of it. But I think there's another factor, which is simply that, you know, we may have a contested election that might bleed on for a while. So I don't want to get too geeky here, you know, at this hour here and without graphs. But if you look at the November contract less the September VIX contract, that premium has been, ever since early August, has been pushing a lot higher. And I think that really tells you the story that it bleeds into this this concept that we may have a contested election. And so I think investors have to face the fact that the election risk is kind of being redefined right now. It's not necessarily who wins and whether the Dems get the House and the Senate. It may be more about just this overall factor of we don't know who's president. That could go on for a while.
Michael, I'm really tight for time, but in 30 seconds or so, have you seen it picked up in volatility? Where do you want to play this through the underlying market?
Well, look, I think right now I've been sort of short NASDAQ, very tactically short NASDAQ volatility. I would love to see the NASDAQ get to 10,000, and I would be backing up the trucks probably at that point into year end, because I do think that this, regardless of what happens on election, assuming we know who's president, I think there's going to be a good sprint into year end, and NASDAQ will lead the way. But I want to see this clear, this get more cleansed first in the immediate term.
Looking forward to catching up November 4th. Michael, I'm sure we'll talk before then. We'll probably talk again later. Michael Purvis there at Toolback. And thank you, sir. Good to see you. Looking well. In this market right now, let's get the sector price action. Here's Abigail.
Well, John, similar to what Michael Purvis was just talking about, the NASDAQ leading. The NASDAQ is certainly leading today. And as a result, the top sector on the day is consumer discretionary. So we're looking at a slightly risk-on tone. I would say it's almost more relief because, of course, consumer discretionary led by Amazon per 2020 standards is a bit defensive. Importantly, the financials, the second best sector, up about 0.8% as bonds pull back and yields rise. And then on bottom, encouraging for the bulls, utilities, a defensive sector. So overall, a tad risk on, John, as the bulls continue to try to buy the dip from the recent pullback.
Abigail, thank you. Coming up on this program, the Trading Diary, that is up next from London and New York. This is Bloomberg.
Let's suppose 10 years from now, when you say you might hang up your spurs at Netflix, what do you think you might want to do when you turn the ripe old age of 70?
I want to have my own interview show.
Well, I'm sure you could get that anytime you want one.
"25 minutes into the session, equities advanced on the S&P 500 up 0.6%. Consumer discretionary, IT doing some of the lifting with Amazon and Apple advancing. That's the market story. Here's the Trading Diary. What to watch through the next couple of days, the next 24 hours. House Speaker Nancy Pelosi holding a news conference 10:45 a.m. Eastern. The Senate voting on the latest stimulus bill at 11:30, and President Donald Trump delivering remarks from Michigan at 7 p.m. Eastern time. We get US CPI data tomorrow, plus the monthly Treasury budget statement to close out the week. From London and New York, for our audience worldwide, thank you for choosing Bloomberg TV in the last 60 minutes or so. Stick with us. This was the countdown to the open. This is Bloomberg TV.
has been interrupted. Uninterrupted service is peace of mind. Kimmy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest-hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents.